Hello, friends. First of all, we want to congratulate you for being interested in learning stock market investing. You may not believe it, but being interested in learning alone puts you ahead of 80% of people in the stock market. And if you watch this full course attentively, we bet that you will become smarter than 95% of people in the stock market. In stock market investing, only those people can succeed who are dedicated to learning. You are about to watch this course, which indicates that you are one of those individuals. In this course, there are a total of 48 lessons, which are divided into 4 chapters. The first chapter is Money and Wealth, where you will understand the difference between money and wealth along with the history of money. The second chapter is Investing. In this chapter, you will learn the reasons for investing, its 5 main types, and the best ways to invest. The third chapter is How Stock Market Works. In this chapter, you will learn what the stock market is and how it operates. Additionally, you will also understand IPOs and their types, Dmat accounts, brokers, and stock exchange. And the last and most important chapter is Stock Market Investing. In this chapter, you will learn various ways to invest in the stock market, different investing philosophies and strategies, the difference between trading and investing psychology, the power of compounding, the right strategy to start investing, and detailed information about all kinds of charges and fees in the stock market. Friends, this course is a complete course in itself, but if you want to further improve your knowledge by solving questions based on the concepts explained in this course, we have created a test for that. The test includes 14 quizzes, 1 final exam, and more than 200 multiple-choice questions. We have also prepared text notes for this course, which will help you to remember the concepts you are about to learn. You can access these additional resources from our mobile app, True Investing Academy, and on our website at academy.trueinvesting.in at a price of just $1. We have provided the links for these in the description and comment box. Before starting the course, let us clarify that we are not registered with SEBI in any way, and we never provide any stock tips or any investment advice. Now we are ready to start the course, so let's begin. Imagine you have 2 job offers. The first job is paying you a monthly salary of 75,000 rupees, and the second job is paying you a salary of 1 lakh rupees for the exact same work. Which job would you prefer to do? Or if you want to buy a mobile phone that is available on one website for 18,000 rupees and on another website, the same mobile phone is available for 15,000 rupees. From which website would you buy the mobile? You might be thinking that it's not a question worth asking. Of course, we would choose the job with a salary of 1 lakh rupees and buy the mobile from the website where the price is 15,000 rupees. In reality, we make these decisions so quickly that we don't even have to think about it, and that's why this becomes even more important. Friends, when it comes to taking money, we want to take as much as possible, but when it comes to giving money, we want to give as little as possible, and we make such decisions in just a few seconds. This means that knowingly or unknowingly, we understand the importance of money, or we can say that our mind knows that money is extremely important for us. And that's why we prefer to make decisions that will leave us with more and more money. Why we make such decisions is not a very difficult question to answer. We can do a lot of things with money. We can live a good lifestyle, buy many things we desire, get good medical services, travel to lovely places, and provide a good life for our family. Along with that, having money also gives us mental peace, because when we have money, we don't have to worry about where the money will come from in the future when we need it. It's possible that some people don't desire a lot of money and prefer to live a very simple life, but you and I know that such people are very few. Most of us want to earn good money and live a good life, and in this course, we will talk about this only. But before that, do we understand what money is, how it originated, and what it means to have money? Let's explore the history of money to find the answer to these questions. Thousands of years ago, people used to engage in business through the barter system, where they would trade goods with each other. This means that if someone had rice and needed sugar, they had to find someone who not only had sugar, but also needed rice. Then, if both parties were willing to trade, they would exchange their respective items and fulfill each other's needs. The problem with the barter system was that it involved direct exchange of goods. As more and more people started producing different kinds of goods, it became increasingly difficult to find someone for direct exchange. Due to this reason, people slowly began to change the barter system. The biggest and most important change came when people adopted the method of indirect exchange instead of direct exchange. In indirect exchange, instead of directly exchanging goods, they started using a common medium of exchange. Through this medium of exchange, people began to buy the goods they desired. People used various items as a medium of exchange, such as seashells, crafted stones, elephant tusks, or salt. Let's understand this with an example. When people made seashells a common medium of exchange, and if someone had rice and needed sugar, they could directly go to someone who needed rice and exchange their rice for seashells. Then, they could take the seashells to someone who had sugar and exchange them for sugar. In this way, trading became much easier than finding someone who had sugar and also needed rice. With the advent of a common medium of exchange, trading became quite convenient. If we observe carefully, the use of seashells here is just like how we use money today. That's why seashells and similar mediums of exchange are also called the earliest form of money. Gradually, people started trading with copper, silver, and gold coins, and in the 7th century, paper money was first introduced in the Tang and Song dynasties of China. In today's digital world, money exists in the form of digital records in our bank accounts. Friends, money has certainly undergone changes over time, but people have always wanted to earn more and more of it. They have put in tremendous efforts and years of education and learned various skills to earn more money so that they can fulfill their desires. But what is it about money that makes us go to such lengths to acquire it? Can we only buy things with money? Or is there something else that is even more important than material possessions? Let's find out in the next lesson. Friends, we saw that money was initially introduced to make trade easier. And even today, money is used exactly in the same way. For example, if we have math teaching skills and we need to buy clothes, we cannot directly exchange our math skills with the shopkeeper for clothes. However, we can definitely teach math to those who want to learn math and charge them money for it. Then with that money, we can buy clothes from the shop. Here we are taking money in exchange for our teaching skills. And then we are giving that money to someone else to get the things we need. Or we can say that we have transformed our math skills into new clothes through money. It means that we are using money for the indirect exchange of goods. And friends, the use of money is only limited to this. If we observe carefully, money itself doesn't hold any value because money on its own cannot provide us with food or clothes. However, by giving that money to someone else, we can buy food and clothes. In this way, the biggest quality of money is that people are willing to give us things in exchange for it. In fact, we don't need money. We actually need different things. And it is only to obtain those things that we require money. In this way, we don't need money itself, but we use the money to fulfill our needs. That's why we want to earn money so that we can easily get whatever we need. Friends, with money, we can of course buy things we like. But the biggest thing that we can get with money is freedom. Yes, you heard it right. You see, most people usually do jobs that they don't want to do from their hearts. However, they receive a monthly salary from that job which helps them run their household, pay their EMIs, and fulfill their family needs. And for that reason, people continue to work in jobs which they don't even like. But suppose we have 10 crore rupees and we have no debt to repay, then the answer for whether we would take a job we don't like might be the same for all of us. And that answer is a resounding no. This means that most of us are doing jobs or studying things we don't like just because we can earn money to fulfill our needs. And until we don't have enough money to meet all our needs, we aren't free to live life on our own terms. And if we don't want a life where we always have to think about money, then we need to take action today. We have to use our money and skills wisely so that we can become wealthy and live a good and happy life. Well, you might be thinking that money and wealth are the same thing. But in reality, my friend, they are completely different things. Now, if money is not wealth, then what is wealth? And how does wealth come from money? Let's explore all these questions in the next lesson. According to the bestseller business writer James Clear, wealth can be broadly categorized into 4 types. The first type is financial wealth. Financial wealth means whether we have things that can give us money to fulfill all our current and future needs. If the answer is yes, then we have financial wealth. The second type of wealth is social wealth. which means how good our social status is and how good our relationships are. Without these things, it is not possible to live a good and happy life. The third type of wealth is time wealth, which means whether we are free to use our daily time as we wish. If yes, then we have time wealth. And the fourth type of wealth is physical wealth, which means our most important thing, our health. If we are healthy, only then can we enjoy life. But if we don't have good health, then everything else is useless. That's why, along with all kinds of wealth, or even more than that, we should pay attention to our health. It's absolutely true that to live a good and happy life, it is very important for us to have all the four types of wealth. But among them, one wealth, without which it becomes extremely difficult to have the other three wealth, is financial wealth. If we have financial wealth, it means that we have a source of money that can easily fulfill all our needs. And because of this, society will consider us rich, and our social status will be good. Having enough money will also ensure that we have better relationships with people, especially with our family, as most family problems are often caused by a lack of money. So, in this way, having enough money will also give us social wealth. At the same time, if we don't have to worry about money, we will be free to spend our time however we like. Because to earn money, we are forced to do things we don't want to do. So without the stress of money, we will also have time wealth. And when we don't have to worry about money and we have the freedom of time, we can invest our money and time in our health and make it much better. Many people often cannot pay attention to their health, because maintaining a healthy lifestyle requires both time and money. However, if we have financial wealth and time wealth, we can comfortably focus on improving our health and lead a healthy life. Now, what this means is if we can create financial wealth for ourselves, then it will become much easier for us to build the other three types of wealth. Friends, many people consider money to be the most important thing. But in reality, there are things that are much more important than money, and there are two main reasons for this. First, the value of money decreases over time, and it's possible that the value of 1 lakh rupees today may become 50,000 rupees in 10 years. And second, no matter how much money we have, if it's not growing, there's a very high chance that it will eventually run out one day. Because of these reasons, we should focus not on money, but on creating things that can continuously generate money for us. And such things are called financial wealth. In the world, many people have made a tremendous amount of money, and almost all of them first created financial wealth, and then their financial wealth brought them a lot of money. Now, the question is, how can we create financial wealth for ourselves, and whether creating financial wealth is easy or difficult? Let's find out in the next lesson. In the last video, we saw that if we truly want to become wealthy, we need to build 4 types of wealth: financial wealth, social wealth, time wealth, and physical wealth. And if we manage to build financial wealth, it will be a bit easier for us to achieve the other 3 types of wealth. Financial wealth means those things that continuously bring us money. And if we need a lot of money in the future, then we need to build such financial wealth which can give us a lot of money. And if any financial wealth has made the most money in the world, it is business. Yes, my friends, if our aim is to make a significant amount of money, then the best option is to start a business. If we look at the list of the richest people in India, almost all of them are the owners of big businesses, and these businesses have made them so wealthy. In business, people become very rich because there is no limit to the growth of a business. A business that started with 1 lakh rupees can grow to 100 crore rupees. Due to this reason, a successful business can make an enormous amount of money. But there is one problem with this. It is not necessary that when we start a business, it will become successful. The truth is, doing business is very risky, and more than 80% of new businesses fail, resulting in losses of lakhs and crores of rupees. Moreover, starting a good business may require a lot of money, due to which taking the risk of starting a business is not suitable for everyone. But there is no need to worry about this, because if starting our own business is not the best option for us to create financial wealth, then we can choose the second best option for creating financial wealth, which is investing. In investing, there is a very high possibility of making a generous amount of money in the long term. Yes, friends, the most money people have made from any financial wealth, other than owning a business, is investing. Whether it's stocks, real estate, mutual funds, or a local business in our city, We can earn a lot of money in all of them. There is not as much risk in investing as there is in starting our own business. Primarily because in investing, we invest our money into businesses that are already successful, so the chances of them failing are much lower compared to starting a new business. And if we make sure to invest only after thinking, understanding, and keeping the rules of investing in mind, then in the long term, we can make a really good amount of money. But in investing, there are many options. Some people invest only in mutual funds, while others invest only in stocks, and some have real estate as their favorite choice. Can we make the same amount of money in all of these types of investments, or is there one that's the best among them? Let's find out in the next chapter, which is about investing. Congratulations, you have completed the first chapter on money and wealth. Let's now take a look at the important learnings from this chapter. First, we learned that knowingly or unknowingly, we understand the importance of money, as we always want to receive more money while selling something, and we want to pay as little as possible when buying something. For this reason, it becomes even more important for us to understand money. Then we learned that before the advent of money, people used to trade things through the barter system. But this had many problems. That's why people created a medium of exchange and started trading with it. Initially, people used seashells, crafted stones, and elephant tusks as a medium of exchange. But gradually they started making metal coins, and later paper money came into use. Then we learned that the most important quality of money is that people are willing to offer us products or services in exchange for it. But our real need is not money, but rather a variety of other things, and we need money to buy those things. Also, if we want to live a good and prosperous life, we not only need money, but also need to build wealth, and money and wealth are two different things. Then we learned that wealth can be classified into four main categories: financial wealth, social wealth, time wealth, and physical wealth. Financial wealth means having those resources that can provide us with the ability to fulfill all our present and future needs. Social wealth means having a good status in society and positive relationships with others. Time wealth means having the freedom to use our daily time in any way we want. And physical wealth means having good health. If we want to live a good life, then it's very important for us to have all the four types of wealth. And having financial wealth can make it easier to attain the other three. Then we learned that there are two best options for building financial wealth: starting a business and investing. And lastly, we learned that starting a business involves a lot of risk, so it may not be suitable for everyone. However, investing is suitable for everyone, and anyone who learns it well can make a fortune in the stock market over time. Before we proceed to the next chapter, don't forget that you can access concise text notes and a quiz with over 200 questions summarizing everything you've learned in this course. Just head over to our mobile app, True Investing Academy, or visit our website at academy.trueinvesting.in. Additionally, we provide an assortment of ebooks and courses that can enhance your understanding of investing and the stock market. We encourage you to explore these valuable resources as well. You'll find the links in the comments and description box below. All right, let's keep the momentum going and now learn about investing. In the previous chapter, we learned that through investing, we can create financial wealth for ourselves, which can provide us with a considerable amount of money in the future. Besides this, there is another very crucial reason why we should invest, and that is inflation. Yes, friends, inflation is the biggest enemy of our money, and because of it, the value of our money keeps decreasing over time, which means we can buy fewer things with the same amount of money in the future. Let's understand this with an example. Let's say in our home, we use 4 liters of mustard oil every month, and currently, its price is 200 rupees per liter, which means we spend 800 rupees on mustard oil every month. Now, if after 5 years, the price of the same mustard oil becomes 400 rupees per liter, then with 800 rupees, we will be able to buy only 2 liters of mustard oil. 5 years earlier, we used to buy 4 liters of mustard oil for 800 rupees, but now, we can only buy 2 liters of mustard oil for the same 800 rupees. This means that the value of our 800 rupees has halved in 5 years, as we can now buy only half of what we could buy 5 years earlier with the same 800 rupees. Actually, inflation is always present in the prices of everything, sometimes high and sometimes low, but generally the prices of all things keep increasing with time. In such a situation, if the value of our money does not increase with inflation, then we will be able to buy fewer things with the same amount of money in the future. In our example, the price of mustard oil has doubled in 5 years. If we want to buy 4 liters of mustard oil after 5 years, we will need to pay an extra 800 rupees from our pocket, because now the price of 4 liters of mustard oil has increased to 1600 rupees from the earlier 800 rupees. However, if somehow our 800 rupees also double and become 1600 rupees in 5 years, then we can buy 4 liters of mustard oil for 1600 rupees, and we won't need to pay any extra money. Well, the important thing to pay attention to here is that in 5 years, the price of mustard oil has doubled, meaning it has increased by 100%. And if our money also doubles in 5 years, meaning if it increases by 100%, then we can buy 4 liters of mustard oil without spending any extra money from our pocket. Because in 5 years, our 800 rupees will become 1600 rupees. In simple words, it means that if we want to maintain the value of our money so that we can buy the same things in the future as we buy now, then we need to increase our money at least with the rate of inflation. Doing this is called wealth preservation, which means saving the value of our money. In India, over the last 60 years, the average inflation has been around 7.5%. This means we need to increase our money by at least 7.5% every year to maintain its value. However, if we want to build good financial wealth for ourselves, we must increase our money at a rate higher than the inflation rate, meaning more than 7.5%. By doing so, not only will the value of our money be maintained, but it will also grow. This process is called wealth creation, which means increasing the value of our money. So, everyone should invest for 2 reasons. First, for wealth preservation, which means saving the value of your money. And second, for wealth creation, which means increasing the value of your money. Now, let's understand what investing actually means. Friends, investing means buying things that can return us more money in the future than what we have spent on buying them. And the extra amount we get by selling those things at a higher price than our buying price is called the profit or return on our investment. If we invest 10,000 rupees in something and after 1 year we sell it for 12,000 rupees, then we will say that we made a 20% return on our investment. This is because we are making a profit of 2,000 rupees on our investment, which is 20% of the 10,000 rupees we initially invested. In India, people invest in many things, like the stock market, bonds, real estate, gold, or bank fixed deposits. But no matter what we invest in, there are only 2 ways to make a profit. The first way is to sell the things we have invested in at a higher price than what we have paid for them. And the second way is to earn income from the things we have invested in. For example, if we buy a residential flat for 20 lakh rupees and rent it out at 10,000 rupees per month, then every month we will receive 10,000 rupees as rent. And if we want to sell the flat after a few years, its price may increase from 20 lakh rupees to 25 lakh rupees. Here, we are making a profit in 2 ways. Firstly, we receive a monthly rent of 10,000 rupees. And secondly, by selling the flat for 25 lakh rupees, we will make a profit of 5 lakh rupees. The monthly income in the form of rent we will receive is called investment income. And the increase in the price of the flat from 20 lakh rupees to 25 lakh rupees is called capital appreciation, meaning the value of our purchased investment has increased. And in any kind of investment, we can make profits only in any of these 2 ways. Friends, how much money we make from our investments depends on 2 things. First, what things we invest in and how long we keep our money invested in that thing. This is because different types of investments have very different levels of risk and return. Now let's understand different types of investing one by one. Friends, today investing in the stock market has become very popular among people. Investing in the stock market means buying shares of companies present in the stock market. When the share prices of those companies increase above the price at which we have bought them, we sell them and make profits. Additionally, as long as we buy and hold shares of a company, the company can give us dividends on those shares, from which we can also make a profit. When the company earns a profit, it can share a part of the profits with its shareholders, which is called dividend. Let's understand this with an example. Let's say we invested 1 lakh rupees to buy 1,000 shares of a company at a price of 100 rupees per share. Now, after 1 year, if the company's share price increases from 100 rupees to 150 rupees, we will make a profit of 50 rupees on each share. If we sell all of our 1,000 shares at the price of 150 rupees each, we will earn a total profit of 50,000 rupees. And if the company also gives a dividend of 5 rupees per share in that 1 year, then we will receive a total dividend of 5,000 rupees on our 1,000 shares at a rate of 5 rupees per share. So, here we will get a total profit of 55,000 rupees on our investment in 1 year. 50,000 rupees by selling our shares at a rate of 150 rupees per share, and 5,000 rupees in the form of dividends on our 1,000 shares at a rate of 5 rupees per share. In the stock market, we can invest in several ways. The first way is to directly buy shares of companies just like we did in our example. The second way is to invest in the stock market through mutual funds. And the third way is to invest in the stock market through ETFs, which are exchange-traded funds. But no matter which option we choose, our investment is generally in the shares of a company. However, the risks, returns, and methods of investing are different for all these three options. Through mutual funds, we indirectly invest in shares of companies. We give our money to mutual funds, which have a fund manager. This fund manager invests our money in companies. This way, investing in the stock market through mutual funds becomes a little easier because we don't have to put in the effort of finding good companies ourselves. Whereas ETFs or exchange-traded funds are a type of fund where a fund manager invests our money in companies similar to mutual funds. The difference is that unlike mutual funds, ETFs can be bought and sold just like individual stocks. We will learn more about mutual funds and ETFs in the upcoming chapters. Let's now understand bond investing. Friends, often when big companies or organizations need money, they take a loan from banks, which they have to pay back to the bank with interest within a prefixed time. But big companies or organizations have another option. Instead of taking a loan from banks, they can borrow money from the public. When the public lends money to a company or organization, it becomes a kind of investment for the public, and this is what we call bond investing. Bonds are a type of investment that lasts for a fixed time period, which we call its maturity. And when we invest in bonds, we receive regular interest payments until its maturity, which is also known as the bond's coupon. And when the bond's fixed time period ends, that is, when it reaches its maturity, we receive back our invested money. If we want, we can also sell bonds on a bonds trading platform before their maturity. However, after selling them, we can no longer receive any interest on them. Let's understand this with an example. Let's assume that AB Limited is a company that needs 100 crore rupees for 5 years. The company decided to raise this money by issuing bonds. For this purpose, they plan to issue 1 lakh bond units priced at 10,000 rupees each, which adds up to a total of 100 crore rupees, meaning 1 lakh units multiplied by 10,000 rupees per unit is equal to 100 crore rupees. The company has set a maturity period of 5 years for these bonds. This means that after 5 years, the bonds will expire, and investors will receive their money back. Additionally, AB Limited is offering a yearly interest of 10% on these bonds. The company issues its bonds in small denominations because it wants to raise money from the public, and by keeping the amount lower, more and more people will be able to invest in bonds. But the company can set any price for its bond units, and often it offers bond units priced at 10,000, 100,000, or 10 lakh rupees. Now, if we want to invest in AB Limited's bonds, we need to invest in at least 1 unit of the bond. Let's say we invest 1 lakh rupees today and buy 10 units of AB Limited's bonds. As specified, these bonds offer a yearly interest of 10%. So for the next 5 years, we will receive a yearly 10% interest on our 1 lakh rupees investment, which amounts to 10,000 rupees each year. After 5 years, when the bond matures or expires, we will get back our invested 1 lakh rupees as well. The interest payment and the return on our original investment directly come into our provided bank account on a fixed date, and we don't need to do anything about this. Well, there are many types of bonds, but in India, the 2 main types of bonds are government bonds and corporate bonds. Yes, friends, the government also raises money from time to time for various projects through bonds. Government bonds are considered quite safe, and they offer slightly higher interest rates compared to savings accounts. On the other hand, corporate bonds are issued by private companies and are relatively riskier than government bonds. That's why they offer a slightly higher interest rate than government bonds. We can easily invest in bonds through banks or through our stockbrokers. Now, let's understand one of the most loved investments around the world, which is real estate investing. Investing in real estate means putting your money into land, or buildings that are constructed on land. In India, the history of investing in real estate goes back a long time. People buy land with the hope that its price will increase in the future, and they will make a profit. Some also buy houses or shops and rent them out to earn a regular income. There are basically 4 options for investing in real estate: land, residential real estate, commercial real estate, and industrial real estate. Land means empty land without any construction, or agricultural land. Residential real estate means houses, apartments, or buildings where people live. Commercial real estate means buildings where businesses operate, like shops, showrooms, shopping malls, office spaces, hotels, marriage gardens, parking lots, etc. And industrial real estate means places used for industrial purposes, such as manufacturing plants, warehouses, factories, logistics hubs, etc. We can invest in any of these 4 options, but there are only 2 ways by which we can make a profit. First, by buying real estate and selling it at a higher price, which is called capital appreciation. And second, by earning rent from our real estate property, which is called rental income. Now, it's entirely up to us to decide among these options which one we choose to invest in real estate. But regardless of whichever option we choose, the most crucial factor in real estate is its location. It is often said that in real estate, 3 things are most important, and those are location, location, and location. Therefore, before investing in any type of real estate, make sure to study its location thoroughly. Usually, we should buy real estate in a location where there is a high possibility of increasing demand in the future. For instance, if we are buying a residential real estate property, we should think about whether people would want to live in that location, whether there are good schools, hospitals, and malls nearby, and whether the property is well connected to roads and how easy or difficult it is to travel to places like the railway station, airport, or anywhere else. Also, before investing in any kind of real estate property, we must look at one more important thing about that property, and that is the cap rate. The cap rate or capitalization rate tells us how much return we can expect from a real estate property. The formula to calculate the cap rate is cap rate equals to net operating income divided by current market price of the property. Here, net operating income refers to the annual rental income from the property minus the yearly cost of managing the property. So we can also write the formula for cap rate as cap rate equals to annual rental income minus cost to manage the property divided by current market price of the property. Let's understand this with an example. Suppose we want to buy a 2 BHK flat for investment purposes. The current market price of the flat is 25 lakh rupees, and it can potentially generate a monthly rent of 12,000 rupees. So in 1 year, we will earn 12,000 rupees multiplied by 12, which is 1,44,000 rupees as a rental income. Additionally, let's assume that it will cost us a total of 14,000 rupees to manage the property in a year. So the net operating income of this property will be annual rental income, 1,44,000 rupees, minus the cost to manage the property, 14,000 rupees, which will be 1,30,000 rupees. Now we can calculate the cap rate for this property. We know that the cap rate is calculated as the net operating income divided by the current market price of the property. In this case, it will be 1,30,000 rupees divided by 25 lakh rupees, which will give us 5.20%. Therefore, the cap rate for this property will be 5.20%. We generally use cap rate to compare 2 properties. If 2 properties seem exactly the same to us, we can compare their cap rates to see which one can give us a higher return. Now it's time to learn about India's most popular investing option, which is gold investing. Friends, gold is a valuable metal that is considered precious. In India, people have been investing in gold for years. They often invest in gold jewelry or gold coins and make a profit when they sell it at a price higher than what they bought it for. We can invest in gold in two broad ways. The first is through physical means, and the second is through digital means. We have been investing in gold through physical means for a long time, like buying gold jewelry, purchasing gold coins, and buying gold-made artifacts. All these methods of investing in gold are physical ways to invest in gold. But there are risks in investing in physical gold that our gold can get lost or someone can steal it. That's why keeping physical gold for a long time becomes quite risky. The solution to this problem is to invest in digital gold instead of physical gold, because investing in digital gold gives us returns just like gold. But everything is digital, so there is no risk of loss or theft here. Through digital means, we can basically invest in gold in 4 ways, and they are digital gold, gold ETFs, gold mutual funds, and sovereign gold bonds. Let's understand each of them one by one. In digital gold, we buy gold in electronic form, which stays visible in our online account. Here we can buy gold in grams or as per the amount, like we can buy 1 gram or 0.01 gram of gold, or we can buy gold worth 100 rupees, 500 rupees, or 5,000 rupees. Many apps offer the option to buy digital gold, but we should only buy digital gold from a trusted and well-known genuine app. Gold ETFs, or gold exchange-traded funds, are a type of funds that are mainly based on the price of gold bullion. We can buy and sell them in the stock market just like shares. Whereas gold mutual funds are a type of mutual funds that invests in gold ETFs. We can buy and sell them just like any other mutual funds. We will learn more about mutual funds in detail in the upcoming chapter. Sovereign gold bonds are different types of government bonds that are based on gold. The price of each bond is equivalent to the market price of 1 gram of gold. Additionally, we receive an interest of 2.50% on our investment amount every year. And when the bonds reach maturity, we get our invested amount back based on the market price of gold at that time. For example, if we invest a total of 50,000 rupees to buy 10 grams of gold bonds at a rate of 5,000 rupees per gram, then we will receive an annual interest of 1,250 rupees on our 50,000 rupees, according to the rate of 2.5% per annum. And if, at the time of bond maturity, the rate of gold increases from 5,000 rupees to 6,000 rupees per gram, we will receive 60,000 rupees for our 10 grams of gold. Okay, let's now understand collectibles investing, which is quite different from regular investing. Friends, collectibles mean things that people collect. For example, some people collect old coins, some collect stamps, and some collect vintage cars. People often collect such items for their hobbies, but sometimes it happens that the price of such old items increases significantly, and those who possess those items can make a substantial profit by selling them if they wish. People usually collect things because they have a strong liking for those items, or they have a certain attachment to them. But if we collect items not just for personal liking but with the hope of selling them at a higher price in the future to make a profit, then we call it collectibles investing. Friends, in this type of investing, the choice of what to collect depends largely on our personal preferences. But we can collect a variety of different items if we want. Commonly collected items include stamps, old coins, art such as paintings or sculptures, vintage cars, rare wines, limited edition watches, sneakers, or items related to special moments. Sometimes it does happen that the price of some collected items increases significantly. But still, buying such items only for investment is very risky because it's nearly impossible to predict how much people would be willing to pay for our collected items 5 or 10 years from now. Also, if we are collecting anything, we need to take great care of it, because the value of these items is considered high only when they are in original condition. Even a minor scratch can greatly diminish the value of collectibles. Generally, the collectibles that hold more value are those that are very expensive and limited edition, such as luxury limited edition watches, handbags, or sneakers, and you need a lot of money to buy them. Besides this, investing in collectibles also comes with higher risks, because there is no ready market for these items. This means that selling our collected items might require a lot of effort. And that's why we shouldn't just collect such items solely for investment purposes. However, if we find joy in collecting certain items and can always keep them with us, then we can certainly create a collection of such items as our hobby. And if their prices increase in the future, it would be a great outcome for us. Friends, so far we have explored 5 different types of investing options: stock markets, bonds, real estate, gold, and collectibles. Now the question is, which among these can we invest in to potentially create the most financial wealth for ourselves? Let's find the answer to this question in the next lesson. Friends, there are so many investment options that it gets very confusing when it comes to choosing where to invest. Different people choose different options. Some believe in investing only in real estate, while others invest solely in gold. Some people, on the other hand, like stocks and nothing else. But if our main goal is to make the most money in the long term, then instead of our preferences, we need to consider the long-term expected returns of all the investing options. Only then will we know where we should invest to make the most money. By investing in collectibles, we can get a yearly return of 5 to 7%. With bonds, we can achieve a yearly return of 6 to 8%. In gold, we can get a yearly return of 7 to 9%. Real estate offers a yearly return of 8 to 10%. And in the stock market, we can earn a yearly return of 12 to 14%. We can see that in the long term, we can get the highest returns from the stock market. Here, the difference in returns of 8 to 10% from real estate and 12 to 14% from the stock market may not seem significant. However, over 20 to 30 years, this seemingly small difference can lead to a difference of lakhs of rupees in our returns. For example, if we invest 1 lakh rupees in all the 5 types of investments for 20 years, then in collectibles with a yearly return of 7%, we will have 3,87,000 rupees after 20 years. In bonds, with an 8% yearly return, we will have 4,66,000 rupees after 20 years. For gold, with a 9% yearly return, we will have 5,06,000 rupees after 20 years. In real estate, with a 10% yearly return, we will have 6,73,000 rupees after 20 years. But in the stock market, with a 14% yearly return, we will have 13,74,000 rupees after 20 years. Now, if we were to invest the same 1 lakh rupees in these 5 types of investments for 30 years, then after 30 years, we will have 7,61,000 rupees in collectibles with a yearly return of 7%, 10,06,000 rupees in bonds with a yearly return of 8%, 13,27,000 rupees in gold with a yearly return of 9%, 17,45,000 rupees in real estate with a yearly return of 10%. And the same 1 lakh rupees in the stock market will grow to 50,95,000 rupees with a yearly return of 14%. Here we can see that in the long term, we can get the highest returns from the stock market. So it's clear that if we want to make the most money in the long term, we should focus on investing in the stock market. Now the question is, why do people make the most money in the stock market compared to all other types of investing? The answer to this is that in the stock market, we actually invest in companies, and there is no limit to the growth potential of companies. Often, good companies become very large in 10 to 15 years, and if we have invested in such companies, our money will also grow at the same rapid speed. In India, over the past 40 years, the stock market has provided the highest returns. Returns from gold, fixed deposits, real estate, and other forms of investment have been significantly lower compared to the stock market. But there are many people who believe that returns are higher in the stock market because there is more risk involved. But in reality, such thinking is plain wrong. And if this thinking is wrong, then what is the truth? And how much risk is there in the stock market after all? Let's find this out in the next lesson. Friends, many people believe that the stock market is very risky, meaning there are more chances of experiencing losses than making profits. However, thinking this way is not entirely correct. Because in the stock market, the chance of making losses depends solely on how we approach investing. We can increase our chances of making losses in the stock market with wrong behavior. But if we want, we can significantly reduce the chances of losses with the right behavior. For example, some people on the road follow all the traffic rules and ride their bikes safely and comfortably, reducing their chances of meeting an accident. However, there are others who intentionally break traffic rules and ride their bikes recklessly, which greatly increases their chances of accidents. In this situation, we cannot say that the likelihood of meeting an accident while riding a bike is the same for everyone, because we can significantly reduce our chances of accidents in bike riding by behaving responsibly. And this same principle applies to the stock market. The chance of incurring losses in the stock market depends mainly on two things. First, it depends on our understanding of the decisions we make, and second, it depends on how long we are investing for. Understanding our decisions means whether we comprehend why we are making the decisions we do in the stock market, and whether we are making those decisions after careful study and analysis. Often we make investments in a company without proper consideration or understanding, based solely on someone else's advice, and such investments frequently result in losses. Friends, the world's most successful investor, Warren Buffett, says that risk comes when we don't know what we are doing, so it's essential that whatever we do in the stock market, we do it with our own knowledge and understanding, so that we can reduce the chance of making losses. You can understand for yourself that if making money in the stock market were as simple as following someone else's advice, then why do more than 90% of people suffer losses in the stock market? The reason is that more than 90% of people incur losses because they invest without proper consideration, without conducting research. They blindly invest in companies based on others' opinions and advice. And usually such companies are not good investments, which leads to losses, and then people label the stock market as risky. Friends, the likelihood of losses in the stock market also depends on how short or long our investment duration is. This is because in the short term, the stock market can move up or down unpredictably. However, in the long term, the chances of the stock market going up increases significantly. And if we truly become long-term investors and invest for 10 years or more, then the chance of making good profits on our investments goes beyond 90%. For example, if a company increases its profit by 20 times in 15 years, it is very likely that its share price will also increase by 20 times in those 15 years. But this does not mean that the company's share price will increase every year. It is possible that the share price may increase by 3 times in 1 year, but decrease by 4 times the next year. But by the end of 15 years, the company's share price will approximately be 20 times following its profit. In the short term, the share prices of companies depend on the mood of the stock market. If the stock market is going up, most companies' share prices tend to go up. And if the stock market is going down, most companies' share prices tend to decrease. Therefore, if we invest in the stock market for the short term, it's possible that the price of the shares we buy might decrease significantly, and we may have to sell our shares in losses. But when we invest for the long term, company share prices follow the growth of the company's sales and profits. If we invest in strong companies for the long term, which consistently increase their sales and profits each year, the share prices of these companies will also rise according to their sales and profit growth. And this will lead to substantial profits on our investments. In this way, the amount of risk or the chance of making losses in the stock market depends solely on how wisely we invest and how long we stay invested. Friends, so far we have understood that by investing in the stock market, we can make the most money. However, to achieve this, we need to know in detail about the stock market. What it is and how it works. Why do companies enter the stock market? What are the different strategies for investing in it? And which strategy can help us make the most money in the long term? We're going to explore the answers to all these questions in the next chapter, which is about the stock market. Congratulations! You have completed this chapter on investing. Now let's carefully go through the important learnings of this chapter once again. First, we learned that investing is primarily done for 2 reasons. First, to preserve the value of our money, which we call wealth preservation. And second, to increase the value of our money, which we call wealth creation. Because of inflation, the value of our money decreases over time. And if we want to maintain the value of our money, we need to earn returns on our money that at least match inflation. But if we also want to increase the value of our money along with preserving it, we need to earn returns on our money higher than the inflation rate. And for that, we have to invest our money. Then we learned that investing means buying things that can return us more money in the future than the money we spent on buying them. And the extra money we receive from these investments is called the profit or return on our investment. In India, people invest in FD, gold, real estate, and the stock market. Then we understood that investing in the stock market means buying shares of companies that are in the stock market. After that, there are two main ways to make profits from this. The first way is to sell the shares at a price higher than the price we bought them for. And the second way is to receive dividends from the companies we invested in. We can invest in the stock market by buying shares directly, or we can indirectly invest through mutual funds or ETFs. Next, we learned that investing in bonds means we are giving a loan to a company or an organization. Bonds are for a fixed time period, which we call its maturity, and we receive interest on our invested amount until maturity. And when the bond reaches its maturity, we get our invested money back. After this, we learned that there are four main options for investing in real estate: land, residential real estate, commercial real estate, and industrial real estate. And in real estate, we can also make a profit in two ways. First, by selling the purchased real estate at a price higher than the buying price, and second, by earning rental income. To compare investments in real estate, we should use cap rates. Then we learned that there are two ways to invest in gold, through physical and digital methods. When investing through physical methods, there is a risk of loss or theft. But when investing in gold through digital methods, there is no such risk. Through digital methods, we can invest in gold in four ways: by buying digital gold, gold ETFs, gold mutual funds, and sovereign gold bonds. Then we learned that if we collect certain items with the expectation that their price will increase in the future, and we can make a profit by selling them, we call it collectibles investing. In this type of investment, we collect something that people will consider valuable in the future and would be willing to pay a higher price to buy it. Usually people collect things like stamps, old coins, art like paintings or sculptures, vintage cars, rare wines, limited edition watches, sneakers, or items related to a special moment. Afterward, we examined the expected returns of all the investment options. This helped us in understanding that in the long term, we can make the most money in the stock market. This is because in the stock market, we invest in companies, and a company can grow significantly in the long term, which is why we can get the most returns in the stock market. Then we saw that thinking of the stock market as extremely risky is not correct, because the risk of losing money in the stock market is influenced by our own behavior. And if we want, we can greatly reduce the chance of loss in the stock market by keeping our behavior in check. We also learned that there are two main reasons for losses in the stock market. First, if we invest without proper understanding and knowledge, then we will significantly increase our chances of loss in the stock market. And second, the less duration we invest for, the more our chances of loss will increase. But if we choose good companies with proper knowledge and understanding and invest in them for 10 years or more, our chance of making a profit will be more than 90%. And this is the key to making a lot of money in the stock market in the long term. Before advancing to the next chapter, we wish to draw your attention to the available resources. You can access concise text notes and a quiz featuring more than 200 questions that summarize the essential concepts from this course. These materials can be accessed via our mobile app, True Investing Academy, and our website at academy.trueinvesting.in. But that's not all. We offer a range of ebooks and courses designed to enhance your understanding of investing and the stock market. Be sure to take a look at them as well. You'll find the links conveniently placed in the comments and description box. Okay, let's now move on to the next chapter where we will learn in detail how the stock market really works. Friends, in the previous chapter we learned that investing in the stock market means investing in the companies present in it. So to understand how the stock market actually works, it's very important to know why and how companies come into the stock market. So let's first understand this concept. Friends, the beginning of any business starts with an idea. Entrepreneurs come up with a business idea in which they see a great opportunity. They work on that business idea and start their business. To further grow the business properly, entrepreneurs then register a company, which can primarily be of four types: sole proprietorship, partnership firm, LLP, and private limited. In the beginning, the company can be registered in any of the four ways. But to enter the stock market, a company must become a private limited company. And if entrepreneurs are planning to establish a large business from the start, they almost always register the company as private limited. During the time of company registration, founders have to invest money in the company. This money helps start the business. We also refer to this money as paid-up capital. And in return for this capital, the founders receive shares of the company. After this, the company's founders start working on building and growing their business, and for this purpose, they might also take loans from time to time. However, as the business grows, a time comes when the company requires a significant amount of money to expand. The company can opt for a loan for this purpose. But if the company already has existing loans, it might become very challenging for them to get additional loans. Also, the company has to pay interest on the loan at a fixed rate. And if for some reason the company can't pay the interest on this big loan amount, it could get into a very serious financial trouble. So considering these risks, the company might not want to take a loan. And then in such a situation, they have to choose another way to get their required money. And this other way is the stock market. Friends, as we observed during the company registration, the founders had invested money in the company and received shares of the company in return. This means the company required money to start its business, and for this, the founders sold the company's shares to themselves, and in exchange, they gave money to the company, which facilitated the start of the company's business. Well, in the stock market, a similar process takes place. When companies need money, they sell their shares to people through the stock market, and in return, they receive money from the people, and the company utilizes this money for its requirements. So in this manner, the stock market serves as a platform where companies can collect money from the public. This helps them gather the money they need to grow their business. Likewise, the stock market offers the public a convenient way to invest in companies, so that they can become a part of the company's growth and make money. And after a company sells its shares in the stock market, the trading or buying and selling of these shares begins to occur in the stock market. Friends, we are repeatedly talking about selling shares to the public, but before that, do we really understand what shares actually are, and what it means to buy shares? Let's explore all these aspects in the next lesson. Let's assume that Mr. Shubham and Mr. Abhishek came up with a business idea. They began working on it and registered a company called SA Private Limited. Along with that, both of them invested 50 lakh rupees each in the company to start the business. In this way, the company had 1 crore rupees to start the business. Here, Mr. Shubham and Mr. Abhishek have started a company. This means as of now, these two are the only partners in the company. But it's possible that in the future, they might need a third or fourth partner, or an investor. In such a situation, there should be a system that allows them to easily bring new people on board as partners and investors for their company. And the system of shares in companies is one such system. Who are the owners of the company? How much the company is worth? And how others can easily invest in the company? To make all these things easy, every new company during its formation is divided into smaller parts, and we call these parts shares. The number of shares in a new company is decided by how much money the founders have put into the company to start their business. So when a new company is formed, its share has a price. We call this the company's face value, and usually it is 10 rupees. It's possible that the company's share price may increase or decrease later on, but the face value tells us the initial price of a single share when the company was established. In our example, the founders had invested 1 crore rupees to start the SA Private Limited company, and if we divide this 1 crore rupees into shares worth 10 rupees each, we will have a total of 10 lakh shares. So this means that the entire SA Private Limited company has now been divided into 10 lakh shares. And now these shares will be given to those who have invested money in the company, which means Mr. Shubham and Mr. Abhishek. Here, Mr. Shubham and Mr. Abhishek have invested an equal amount of 50 lakhs rupees each in the company. This means that both of them are equal partners with 50-50% ownership. Because of this, they will also receive an equal 50% share of the company's total 10 lakh shares, which means each of them will get 5 lakh shares. With the current share price of 10 rupees, if we calculate, each partner has received shares worth 50 lakh rupees, which is equivalent to their initial investment. Here, the entire SA Private Limited company is divided into 10 lakh parts or shares, which means 10 lakh shares of the company is equal to 100% of the company. In this way, 10,000 shares of the company would be equal to 1% of the company. And if we buy 10,000 shares from Mr. Shubham and Mr. Abhishek, we would become the owner of 1% of their company, SA Private Limited. So, friends, the concept of shares essentially signifies ownership in a company. And buying the shares means owning a part of that company. The more shares we buy of a company in the stock market, we become owners of more of that company's smaller parts. However, we can only buy shares of a company when the company has already sold or is selling its shares in the stock market. And companies sell their shares in the stock market through a process called IPO. Now, let's understand what an IPO is in the next lesson. Friends, in the last video, we saw that Mr. Shubham and Mr. Abhishek started their company, SA Private Limited, by investing 50-50 lakh rupees each. Now, suppose that Mr. Shubham and Mr. Abhishek worked very hard to grow their company. And in 10 years, they increased the company's annual revenue to 200 crore rupees and annual profit to 30 crore rupees. Now, Mr. Shubham and Mr. Abhishek want to rapidly expand their business. And for this, they will need to build new factories, buy new machines, and hire thousands of people. They calculated that they would need approximately 100 crore rupees for all of this. And they decided that they will fulfill their need of 100 crore rupees by selling shares of their company in the stock market. When companies sell their shares for the first time in the stock market to raise money, the process is called IPO, or Initial Public Offer, because the company offers to sell its shares to the public in the stock market for the first time. Launching an IPO is a highly complex process, because the company has to create numerous detailed documents, and they have to attract investors to invest in their company. And for this reason, companies hire investment banks for issuing their IPOs, whose main job is to assist companies in launching IPOs. So before launching the IPO, companies have to work together with investment banks to create a detailed document called DRHP, or Draft Red Herring Prospectus. This document contains the company's complete history, business information, risks associated with the business, future plans, and many other pieces of information, all in a very detailed manner. Companies are required to submit this document to SEBI, which stands for Securities and Exchange Board of India. SEBI regulates the Indian stock market, similar to how RBI regulates Indian banks. Afterwards, SEBI studies the submitted DRHP and grants permission to launch the IPO. And then the company and investment banks work together to determine the share price for the IPO, and then the IPO is launched, making it available for the public to apply. It is worth noting that there are mainly two types of IPOs: mainline IPO and SME IPO. Mainline IPOs are IPOs of large companies that launch IPOs of 100 crore rupees or more. On the other hand, SME IPOs, which stand for Small and Medium Enterprise IPOs, are IPOs of small companies that launch IPOs of less than 100 crore rupees. While mainline IPOs are open for up to 3 days, SME IPOs are open for up to 4 days. And if we want to buy shares of a company at the time of the IPO, we need to apply for shares while the IPO is still open. But friends, it's not necessary that if we've applied for a company's IPO, we will definitely receive the shares. What is the reason for this? And how an IPO really works? Let us learn all this in the next lesson. In the previous video, we saw that Mr. Shubham and Mr. Abhishek need 100 crore rupees to expand their business, and now they are launching the IPO of their company SA Limited for this purpose. One important thing to note here is that when the IPO is launched, the word private is removed from the company's name, because launching an IPO means the company is no longer private, and now it's a public company. Let's assume that the company and investment banks together decided that to collect 100 crore rupees, they will sell 5 lakh shares of the company in the IPO at a price range of 1900 rupees per share to 2000 rupees per share. Often in the IPO, companies set their prices within a range, which is called the price range of the IPO. The lowest price within the range is called the floor price, and the highest price is called the cap price. Here, SA Limited is launching its IPO in the price range of 1900 rupees to 2000 rupees. So the floor price here will be 1900 rupees per share and the cap price will be 2000 rupees per share. Friends, in the IPO, we get shares in lots or bundles, and the price of one lot cannot exceed 15,000 rupees. In this way, how many shares will there be in a lot depends on the share price of the IPO. Here, the share price of SA Limited is between 1,900 to 2,000 rupees. Therefore, in one bundle, there will be 7 shares, calculated as 15,000 divided by 1,900 to 2,000. Similarly, if the company's share price in the IPO would have been between 2,900 to 3,000 rupees, then, in one lot of 15,000 rupees bundle, there would be 5 shares. Now, the IPO of SA Limited will be open for 3 days, and anyone can apply for it. To apply, it's necessary for us to have a Dmat account, which we can open with any broker. We'll learn more in detail about the Dmat account later. Friends, in an IPO, we can apply online through our broker's platform, and we can apply for one or more than one lot. When we apply, the amount for the shares we are applying for gets blocked in our bank account. But it's not necessary that if we apply in an IPO, we will definitely get shares. This is because every company offers a fixed number of shares in an IPO, yet people often apply for more shares than the company has offered. In our example, SA Limited is offering a total of 5 lock shares in its IPO. However, in the IPO, since anyone can apply for as many shares as they want, it's possible that when people's applications are combined, they may have applied for a total of 50 lock shares. But the SA Limited company is only offering a total of 5 lock shares to the public. In such a scenario, who will get the shares and who won't is decided by a computer-based lottery. In this process, whether we receive shares or not depends on our luck. So, if we are allotted shares in the IPO, the blocked amount in our bank account gets transferred to the company, and the company's shares are credited to our Dmat account after a few days. But if we don't get the allotment of shares in the IPO, the blocked amount is returned back to us. A few days after the allotment of companies' shares in the IPO, buying and selling of shares begin in the stock market, and then anyone can buy and sell the shares. One important thing to note here is that when a company sells its shares to the public for the first time during an IPO, it is called the primary market. But after the IPO, when the public buys and sells those shares among themselves, it is called the secondary market. And after the IPO, companies are called listed companies in the stock market, publicly listed companies, public companies, or simply listed companies. It's important to know that every company can launch its IPO in 2 ways. One is called the fixed price method, and the other is called the book building method. Let's learn about both of these methods in the next video. Friends, every company can launch its IPO in 2 ways. One is called the fixed price method, and the other is called the book building method. In the fixed price method, a company fixes the price of its shares beforehand, on which it sells its shares in the IPO. And all individuals receive shares in the IPO at this fixed price. Whereas in the book building method, a company sets a range for the price of its IPO. And during the IPO, people apply for the company's shares in this price range. Only after the application period for the IPO ends, the final price of the shares is determined, and the company then sells its shares in the IPO at that price. Let's understand these through real IPO examples. The IPO of Delivery Limited came between the 11th of May 2022 and the 13th of May 2022. In the IPO, the company had set a price range of 462 rupees to 487 rupees for its shares. This means that the IPO was introduced using the book building method, and hence it is called a book-built issue IPO. People applied for the company's shares in this IPO within the range of 462 rupees to 487 rupees. And after the IPO application period ended, the final price of the IPO was determined as 487 rupees. This means that people received shares of Delivery Limited in its IPO at a price of 487 rupees. On the other hand, the IPO of QMS Medical Allied Services Limited came between the 27th of September 2022 to the 30th of September 2022. In this IPO, the company sold its shares at a fixed price of 121 rupees per share. This means that the IPO was brought using the fixed price method, and that's why it's called a fixed price issue IPO. During the IPO application period, people applied for shares at the fixed price of 121 rupees, and they also received the shares at the price of 121 rupees per share. Friends, there are all kinds of investors in the stock market. Some people can invest only a small amount in stocks, while big investors can invest millions of rupees. Thus, to make sure all types of small and big investors can get shares in the IPO, a reservation system has been created. In IPOs brought through the fixed price method, 50% of the shares are reserved for retail investors. Retail investors refer to common investors who apply for shares worth less than 2 lakh rupees in the IPO. The remaining 50% of the IPO is available for all the larger investors who apply for a minimum of 2 lakh rupees or more worth of shares in the IPO. On the other hand, in IPOs brought through the book-building method, 35% of the shares are reserved for retail investors who apply for shares worth less than 2 lakh rupees. Then 15% of the shares are reserved for non-institutional investors, or NII. They are also known as high net worth individuals, or HNI. These are wealthy investors who apply for shares worth a minimum of 2 lakh rupees or more in the IPO. The remaining 50% of the shares are reserved for qualified institutional investors, or QIB. QIBs mainly include banks, mutual funds, and investment companies. Well, it's up to the company to decide whether they launch their IPO through the fixed price method or the book-building method. But usually for mainline IPOs, which are IPOs with an amount of 100 crores or more, the book-building method is used. And for SME IPOs, which are IPOs with an amount less than 100 crores, the fixed price method is usually used. However, it's also possible that a mainline IPO could use the fixed price method, or an SME IPO could use the book-building method. And this is up to the company to decide which of the two methods they use for their IPO. Friends, in the previous lesson we learned that to apply for an IPO, we need a special kind of account, which we call a Dmat account. Let's now understand more about this in the next lesson. Friends, before the advent of digital banking, we used to keep money in the form of cash, and all transactions were also done in cash. But there were many risks in this, like the notes getting damaged, torn, or lost. Moreover, if there was too much cash, there was also a fear of theft. But today in digital banking, we don't face any such problems. Our money is safely stored in our bank accounts, and we can easily do transactions even from our mobile phones. This has made banking much easier for us. Similarly, earlier when people bought shares of companies, they used to receive share certificates of the companies, which were in the form of paper. And with these papers, one got to know who owns these shares. But here too, there were many risks, like the certificates could get damaged or lost over time, or someone could create fake certificates. Considering these issues, the government decided in 1996 that instead of paper certificates, shares will now be given in a digital form, which will be saved in a digital account. When people buy shares, they will be saved in this digital account. And when people sell shares, they will be debited from this account and sold. And this digital saving account for shares is what we call a Dmat account. The full meaning of Dmat account is dematerialized account. Dematerialized means converting a physical thing into digital form. And in a Dmat account, we convert physical share certificates into digital form. Dmat accounts are opened in the government's depository companies. And in India, there are only 2 depository companies where we can open our Dmat account. The first one is CDSL, which stands for Central Depository Services Limited, and the second one is NSDL, which stands for National Securities Depository Limited. Although our Dmat account is opened in CDSL and NSDL, but in reality we cannot directly open our Dmat account with them. Our Dmat account is always opened through a stockbroker, and every stockbroker is linked to either CDSL or NSDL. In this way, the broker is the one who opens our Dmat account in CDSL or NSDL. For example, Zerodha is a stockbroker, and it is linked to CDSL. This means that if we open a Dmat account through Zerodha, our Dmat account will be opened in CDSL. In India, there are hundreds of stockbrokers, but no matter through which broker we open our Dmat account, it will be opened either in CDSL or NSDL. Friends, in the Dmat account, the shares we purchase are stored. However, we need another account through which we can buy and sell shares, and this account is called a trading account. Actually, whenever we open an account with a broker for investing, they open both our Dmat and trading accounts. The trading account is opened with the broker, and the broker opens our Dmat account with either CDSL or NSDL. We can consider the trading account as a bridge between our bank account and Dmat account. Because first we deposit money from our bank account to the trading account, Then we use that money from the trading account to buy shares, which are then saved in our Dmat account. This way, the trading account provides us with the facility to buy and sell shares. So far, we have learned about the stock market, shares, IPO, Dmat account, and trading account. Now we are going to understand the stock exchange and stock market index. And after that, we will be fully prepared to learn about stock market investing. So let's understand the stock exchange and stock market index. Stock exchange is a platform where buying and selling of companies' shares takes place. In India, there are two main stock exchanges. The first one is BSE, which stands for Bombay Stock Exchange, and the second one is NSE, which stands for National Stock Exchange. And after an IPO, when trading of a company's shares begins, it occurs on these two exchanges. If a company wants, it can launch its IPO on one or both of these exchanges. But most companies launch their IPOs on both stock exchanges, after which the trading of their shares starts on both stock exchanges. We often hear in the news or from other people that the Sensex and Nifty went up today or the Sensex and Nifty went down today. But what are these Sensex and Nifty after all? And what does it mean when they go up or down? Let's understand this. On NSE, there are approximately 2,000 listed companies, and on BSE, there are around 5,000 listed companies. Every day, millions of people buy and sell the shares of these companies. This makes the prices of these companies' shares go up and down. If we want to know how well a single company's shares is performing, we can look at its share price. But if we want to know how all the big listed companies are performing together in the stock market, then it becomes very difficult for us. And to understand this very thing, stock market index has been created. A stock market index shows the average performance of the shares of the biggest companies listed on a specific stock exchange. The name of the index for BSE is Sensex, which stands for Sensitivity Index, and it represents the performance of the shares of the 30 largest market cap companies on BSE. The index for NSE is called Nifty, which stands for National Stock Exchange 50, and it indicates the performance of the shares of the 50 largest market cap companies on NSE. Friends market cap or market capitalization means the market value of a company in the stock market. And to calculate the market cap, we multiply the company's share price by its total number of shares. For example, if a company has 5 crore shares in total, and the price of one share is 300 rupees, then the company's market cap would be 5 crore into 300 rupees, which is equal to 1,500 crore rupees. So when we say that the Nifty has gone up today, what it means is that the average share price of the 50 companies in the Nifty index has increased. Now it's possible that out of the 50 companies in the Nifty, the share price of the 17th of May have decreased, but the share prices of the remaining 33 have gone up, causing the Nifty to rise up. BSE had started the Sensex index in 1979 with a value of 100, which today, in about 43 years, has increased to around 65,000, meaning it has grown 650 times. Similarly, NSE had started the Nifty index in 1996 with a value of 1,000, which today, in about 26 years, has increased to around 19,000, meaning it has grown 19 times. Sensex and Nifty are the two most important stock indices in India, but there are also many other indices that show the performance of specific sectors or companies. For example, there is the Nifty 200 index, which shows the performance of the top 200 companies with the highest market capitalization listed on the NSE. Another example is the BSE IT index, which indicates the performance of only IT companies listed on the BSE. The BSE and NSE stock exchanges are open from Monday to Friday, every morning from 9:15 a.m. to evening 3:30 p.m. And we can buy and sell shares only during this time. Additionally, apart from Saturdays and Sundays, the stock exchange remains closed on many government holidays as well. So now we have understood what the stock market is and how it works. Let's move on to the next chapter and learn about how investing is done in the stock market. Congratulations! You have completed this chapter on how the stock market works. Let's now take a close look at the important learnings from this chapter. We learned that the stock market is a platform that allows companies to raise money for their needs, and also allows investors, which means us, to invest money in companies, so that we can become a part of the company's growth and make money. Then we learned that shares are small parts of a company, And when we buy them, we become owners or shareholders of a small part of the company. And through the IPO process, companies raise money by selling these shares to the public. We can apply for the company's shares during IPOs. Then we learned that IPOs are mainly of two types. The first is called mainline IPO, and the second is called SME IPO. Mainline IPOs are those IPOs in which a company launches its IPO of 100 crore rupees or more, whereas SME IPOs are those IPOs in which a company launches its IPO of less than 100 crore rupees. Next, we learned that every company can launch its IPO using two methods. The first is the fixed-priced IPO method, in which the company predetermines the share price for its IPO. And the second method is the book-building IPO method, in which the company provides a range for the share price of its IPO. And the final share price is determined after people apply for it. Companies can launch their IPO using either of these two methods. Then we learned that in order to buy shares, we need to open a Dmat and trading account. In the Dmat account, the shares we buy are stored digitally. And at last we learned that in India, there are two main stock exchanges, BSE and NSE. Each exchange has a main index that shows the average performance of the largest companies listed on both exchanges. The index for BSE is called Sensex, and the index for NSE is called Nifty. Before we jump into the next chapter, here's a quick reminder. You can access focused text notes and a comprehensive quiz featuring more than 200 questions that cover the key takeaways from this course. Simply visit our mobile app, True Investing Academy, or check out our website at academy.trueinvesting.in. And guess what? We've got a plethora of ebooks and courses that can supercharge your investing knowledge. Be sure to take a look at them as well. You can find the relevant links right in the comments and description box. All right, let's now proceed to the next chapter, where we will understand different methods and strategies for investing in the stock market in detail. Friends, in the stock market, we can invest in two ways. The first is directly, where we ourselves find companies and invest in them. And the second is indirectly, where we invest in mutual funds, ETFs or PMS. In this method, there are fund managers who use their understanding to find good companies and invest our money in them. It's not that one of these methods is right and the other is wrong. We can make money in the stock market using both methods of investment. However, the effort required, the returns, and the risks in both methods are quite different. By buying shares directly, we can make significant profits, because it's possible that the share price of the company we've invested in may increase 100 times, and all the big and successful investors have made money by buying shares directly. But it's also possible that the company's share price we invest in may decrease by half, thus reducing our investment by half. So in stock market investing, whether our money will increase or decrease depends on how wisely and knowledgeably we invest. Friends, if you want to become a doctor, would you start performing someone's heart surgeries right away? While it might sound funny, but in the stock market we do the same thing. We hear about stock market investing from someone, and then we directly start buying shares of companies without thinking, which can be extremely risky for our hard-earned money. There are more than 7,000 companies in the stock market. But investor Vijay Kerdia suggests that out of these 7,000 companies, only about 500 companies are worth investing in. So if we invest without proper knowledge and careful consideration, there's a very high chance that we might end up investing in a bad company and then we will make losses. You are watching this course. This proves that you want to gain the necessary knowledge to become a successful investor. Our only request to you is that first continue learning more and more about investing in this manner. And only after that, start investing with larger amounts. So friends, making big profits by directly buying shares is possible. But doing this without proper knowledge and understanding of investing is very risky. If we want to make a lot of money in the stock market, then first we have to gradually gain the right knowledge and mindset about it. And for this, we can research about the strategies of all successful investors on the internet. Read numerous books on investing, watch interviews, read blogs, and learn from many good investors by following them on social media. On the other hand, when we invest indirectly, we don't have to put in as much effort. We simply need to invest our money in mutual funds, ETFs, or PMS. These have a fund manager who has a long experience in stock market investing. They work hard to find good companies and invest our money in them. But for this service, they charge us a fund management fee, which can range from 1% to 3% of our investment amount. Friends, through mutual funds, ETFs, and PMS, we can definitely invest indirectly in the stock market. But these three are quite different from each other. Let's now understand them one by one. Friends, mutual fund is made up of two words. The first is mutual, which means something that is shared by many, and the second word is fund, which means money. So this way, a mutual fund means shared money, or a shared fund. Yes, friends, a mutual fund is a shared fund in which all investors' money is pooled. And then, a mutual fund's fund manager uses this pooled money to invest in the stock market, which results in the growth of our invested money and we gain profit. Folks, just like when we invest in companies, we receive shares. Similarly, when we invest in a mutual fund, we receive units of the mutual fund. And just as every share has a price and we make a profit when it increases, in the same way, every mutual fund unit has a net asset value, or NAV. And as the NAV of our mutual fund units increases, we gain profit. Let's understand this with an example. Suppose that AB Fund is a mutual fund in which we have invested 1 lakh rupees and its NAV is 50 rupees per unit. This way, we will receive 1 lakh rupees divided by 50, that is 2,000 mutual fund units. Now, if after 2 years, the NAV of these mutual fund units increases from 50 rupees to 75 rupees, then the value of our 2,000 units will be 2,000 into 75, that is 1,50,000 rupees. And we will make a profit of 50,000 rupees on our 1 lakh rupees investment. A significant difference between shares and mutual fund units is that the price of shares changes throughout the day because people keep buying and selling them every second. But this doesn't happen with the NAV of mutual fund units. Every day, the NAV of mutual fund units changes only once, and this happens after the closure of the stock market. And on any given day, all investors who invest in a mutual fund receive mutual fund units at the same NAV. Guys, in mutual funds, we can invest in two ways. The first is lump sum, and the second is SIP, or systematic investment plan. Lump sum investment means putting a large amount in the mutual fund at once, while investing through SIP means putting small amounts consistently into the mutual fund every month or every week. And it's up to us to decide the SIP amount, whether it's 500 rupees, 1,000 rupees, 5,000 rupees, etc. We can easily start and stop SIP and also change the SIP amount easily. It's not necessary that we have to choose only one option out of these two. We can save money from our salary and invest it through SIP in a mutual fund. And when we receive a larger amount from somewhere, we can invest that money in the same mutual fund or any other mutual fund as a lump sum. We make profits in mutual funds only when the companies in which mutual funds have invested perform well. That's why it's crucial for the mutual fund's fund manager to conduct thorough research and analysis before investing our money in companies. And fund managers do exactly that. Fund managers themselves conduct research, and they also hire many research analysts who constantly search for good companies in various sectors. And doing all this stuff costs a lot for mutual funds. And that's why mutual funds charge us a fee for managing our funds, which we call the total expense ratio, or simply the expense ratio of mutual funds. According to government rules, this can be anywhere from 0 to a maximum of 2.25% in India. What this means is that if a mutual fund has an expense ratio of 1% and the mutual fund generates a return of 20% in a year, then in reality, we will receive a return of 20% minus 1% expense ratio, which is 19%. This means that the higher the percentage we pay as expense fees, the lower our actual return becomes. And that's why it's extremely important for us to invest in those mutual funds where the expense ratio is low. Because a seemingly small difference in expense ratio can lead to significant losses in the long term. And if we want to easily invest in mutual funds with lower expense ratios, then we need to understand the difference between regular and direct mutual funds. Let's learn about them in detail in the next lesson. Friends, back when there was no internet and very few people were investing in mutual funds, mutual fund companies had to rely on distributors to sell their mutual funds to people. And for this purpose, mutual funds had to pay these distributors a yearly commission. This increased the expenses of mutual funds, meaning their expense ratio would increase. But then in 2013, SEBI, or Securities and Exchange Board of India, decided that now that everything can be done online and there are many mutual fund investors, investors should have the option to invest directly in mutual funds without the need for distributors. And so SEBI established the rule that every mutual fund, along with the pre-existing distributor system, must provide investors with the option to invest directly in mutual funds. SEBI named the mutual funds that were sold through distributors as the regular plan, and the mutual funds bought directly from the mutual fund company as the direct plan. So today we can invest in all mutual funds in two ways, through the direct plan and through the regular plan. The direct plan does not involve any distributor, so its expense ratio is lower than that of the regular plan, which helps us save lakhs of rupees in the long term. For example, suppose that we have invested 10,000 rupees each month through both direct and regular plans in a mutual fund for 15 years. The expense ratio for the direct plan is 0.5%, and for the regular plan it is 1%. Now, if this mutual fund generates a yearly return of 16% over 15 years, then in the regular plan, the value of our investment will be 67 lakhs, 68,631 rupees. However, in the direct plan, the value of our same investment will become 71 lakhs, 16,994 rupees. This means that due to a higher expense ratio of just 0.5% in the regular plan, we will incur a loss of 3 lakhs, 48,363 rupees. Therefore, we should always invest in mutual funds through the direct plan. Every time before investing in a mutual fund, we must make sure whether we are investing through direct plan or regular plan. Because often mutual funds bought through banks or a mutual fund advisor are of regular plans, in which we have to lose profits worth lakhs of rupees in the long term. Now let's understand how to invest in the stock market using ETFs. Friends, the full form of ETF is Exchange Traded Fund, which means a fund whose trading takes place on the stock exchange. We saw in mutual funds that when we invest in a mutual fund, we receive units of that mutual fund. And the price of these units changes only once a day after the market closes. But guys, ETFs are a kind of funds that work differently. ETFs units are traded in the stock market just like a stock, which is why their price changes every second. And we can easily buy and sell them like stocks. There are various types of ETFs, such as stock ETFs, bond ETFs, commodity ETFs, gold ETFs, or real estate ETFs. And the type of ETF determines where its funds are invested. For example, in stock ETFs, the ETF's funds are invested in stocks, whereas in gold ETFs, the ETF's funds are invested in gold. There is another difference between mutual funds and ETFs, and that is, in ETFs we don't have to pay any management fees. But since we buy and sell ETFs just like shares, we have to pay brokerage and taxes just like shares when we're buying and selling them. We will learn more about all the fees and brokerage associated with the stock market later in this course. So if we don't want to directly invest in stocks ourselves, then mutual funds and ETFs are the best options for investing indirectly in the stock market. We can easily open a Dmat account and start investing in them. We don't even need to do extensive research and understanding of them. And we can start investing in mutual funds or ETFs with as little as 100 rupees. Friends, if we are regularly saving well and investing regularly in mutual funds or ETFs, we can make good profits in the long term. But for this, it is necessary to invest regularly, no matter if the stock market goes up or down in the short term, because in the long term, the market almost always goes up. Now let's understand another way of investing in the stock market, which is PMS. Friends, mutual funds and ETFs are excellent options for the general public to invest. And keeping this in mind, SEBI has created many rules to ensure the safety of common investors. These rules prevent mutual funds and ETFs from adopting various risky investment strategies. But if we have a larger sum of money and we want to invest without any restrictions, then we can invest in PMS for that purpose. The full meaning of PMS is Portfolio Management Services. It's a bit different from mutual funds and ETFs. To invest in PMS, we need to open a new Dmat and bank account with the PMS provider. In PMS, our money doesn't go into a common fund. Instead, it remains in our newly opened bank account opened through PMS. There's a portfolio manager in PMS who manages our investments, and the shares purchased with our money are stored in our new Dmat account. So this way, in PMS, the shares are bought under our name and using our money. It's just that the portfolio manager handles the management of our portfolio. Guys, in PMS, the charges for investing are higher compared to the charges for investing in mutual funds and ETFs. Here, we need to pay yearly management fees of 1 to 3% on our investment amount, along with an entry fee of 1 to 3%, and then we also have to pay brokerage fees for buying and selling shares. But the most important thing to know about PMS investing is that we need a minimum of 50 lakh rupees to start investing in it. This is because PMS involves a higher risk compared to mutual funds or ETFs. Therefore, having a substantial amount of money is crucial for investing in PMS. There are mainly 3 types of PMS. First is discretionary PMS, where the portfolio manager himself manages our entire portfolio. He buys and sells shares on their own without asking us. Second is non-discretionary PMS, where the portfolio manager consults us before buying or selling any stock. We decide whether to invest or not, but the buying and selling of shares are managed by the portfolio manager. And if we want, we can also suggest the portfolio manager to buy stocks according to our preferences. And third is advisory PMS, where the portfolio manager only gives us advice on buying or selling stocks. Then it's up to us to make the decision to buy or not. Friends, in the stock market, both direct and indirect investment approaches are right. And if something isn't right, it's simply avoiding investment altogether. If we want to learn investing and manage it ourselves, then we should definitely invest directly. However, if we prefer not to do so, investing indirectly through mutual funds or ETFs is a suitable choice. Investing in PMS requires a substantial amount of money, and it's also risky. So before investing in PMS, we should consult a good financial advisor. Friends, we have understood the methods of indirect investing in the stock market. Now we will understand the details of direct investing in the stock market. But before that, let's know why the prices of shares increase in the stock market. We can achieve significant profits in the stock market only when we invest in companies that perform well in the long term. And performing well in the long term means that the company consistently increases its sales and profits over time. And when a company does this, its share price rises, leading to profits for us. Now the question is, why does an increase in a company's sales and profits result in a higher share price? What's the ultimate connection between sales, profit, and share price? Let's understand this with an example. Suppose that Mr. A, Mr. B, and Mr. C all bought one house each for investment. Their plan is to rent out the houses for now and sell them after 5 years when the house prices have gone up. Let's also assume that all 3 houses are similar, so their rents are the same. So, Mr. A, Mr. B, and Mr. C rented out their respective houses, and every month they started receiving rent from their houses. 5 years passed by like this, and in these 5 years, Mr. A's home condition became very bad. He didn't take care of his house at all, and there were leaks in the house and cracks in the walls. Mr. B somewhat looked after his house and arranged for repairs as needed over time. But Mr. C paid a lot of attention to his house. He installed an air conditioner, conducted top-notch repairs every 6 months, worked hard with the tenants to maintain the house well, and even added an extra room on the terrace. Friends, in these 5 years, all 3 individuals managed their houses differently. Mr. A's home is worse than before. Mr. B's home is in decent shape, but Mr. C's home is much better today than before. And because of this, there will be a difference in the rents they can charge for their houses. And you understand that now Mr. C's home will get the highest rent. Now, if today Mr. A, Mr. B, and Mr. C all 3 want to sell their houses in this condition, then who will get the most money for his house? The answer is not difficult at all. It's Mr. C. Here we are understanding that in this scenario, Mr. C will receive the most money for selling his house. But what's the reason behind it? The reason is that in the past 5 years, Mr. C has taken good care of his house and improved its ability to generate rent. And it is for this reason that when Mr. C sells his house, he will receive more money compared to Mr. A and Mr. B. Friends, in the stock market, the same thing happens. The company's promoters work hard over time and make good decisions and increase the company's ability to make profits. As a result, the company's profit keeps increasing every year. Seeing the improved ability to make a profit of the company, investors are willing to give more money for its shares. This causes the share prices of the companies to rise, and we make a profit. But we should always remember that in the short term, a company's profits might be increasing, but its share price might decrease instead of rising. This is because short-term share prices are heavily influenced by market conditions. If the market is booming, the prices of most company shares tend to rise, whether or not the company is increasing its profit or not, or even making losses. Similarly, if the market is declining, the share prices of many companies tend to fall, regardless of whether the company is making more profit or not. But in the long term, the market's influence on companies' share prices is canceled out. And then, the share price of a company goes where its profit or profit-making abilities goes. If a company increases its ability to generate profits 100 times over the long term, then its share price can also provide returns of around 100 times during that period. Whereas if a company fails to enhance its ability to generate profit or starts incurring losses in the long term, then its share price might decline, and we may incur losses on our investments. Friends, we've now understood how an increase in share price leads to profits in the stock market. Now let's understand the other way of making a profit in the stock market, which is through dividends. When a company makes a profit, it can choose to distribute a part of that profit to its shareholders. And this portion of the company's profit that is distributed is called dividends. For example, if we have 1,000 shares of a company, and that company declares a dividend of 10 rupees per share, then we will receive a total dividend of 10,000 rupees for our 1,000 shares. The dividend is directly deposited into the same bank account that we provided while opening our Dmat account. Dividends are often expressed in the form of a percentage of the company's face value. For example, if a company has a face value of 5 rupees and it declares a dividend of 5 rupees per share, it is said that the company has declared a dividend of 100%. Similarly, if the same company declares a dividend of 10 rupees per share, it will be said that the company has declared a dividend of 200%. This is because the company's dividend of 10 rupees per share is twice the face value of the share, which is 5 rupees. If we already own shares of a company, whenever the company issues dividends, they will be credited to our bank account, and this will continue as long as we hold those shares in our Dmat account. But if we are buying shares of a company solely to receive dividends, we need to pay attention to 4 important dates related to dividends. And these 4 dates are announcement date, ex-dividend date, record date, and payment date. The announcement date is the date when a company announces that it will give dividends. On this date, the company also declares the amount of dividend it will give, allowing the public to know about the upcoming dividend distribution. After announcing dividends, the company starts preparing to give the dividend. The most important thing in this is to decide which shareholders will be given the dividend, as millions of people are buying and selling the company's shares every day. For this purpose, the company chooses a date called the record date. And on the record date, whoever has company shares in their Dmat accounts, the company gives dividends to them. So if we want to receive a company's dividend, we should have the company's shares in our Dmat account on the record date. This means we need to buy the shares 2 days before the record date. Because when we buy shares, it takes 2 business days for them to appear in our Dmat account. For instance, if we buy a share on Monday, it will appear in our Dmat account by Wednesday evening. To prevent confusion among investors, the company announces another date called the ex-dividend date. The ex-dividend date is 1 day before the record date. And if we want the company's dividend, we need to buy its shares 1 day before the ex-dividend date. Next comes the day when the dividend is credited to our bank account. And this day is called the dividend payment date or payment date. On this day, dividends are credited to our bank account, which is linked to our Dmat account. For example, a company announces on the 1st of September 2022 that it will give dividends. For this, they set the record date as the 28th of September 2022, and they set the payment date as the 10th of December 2022. Now, since the ex-dividend date is 1 day before the record date, here the ex-dividend date to receive dividends will be the 27th of September 2022. And if we want dividends, we need to buy the company's shares 1 day before the ex-dividend date, which is by the 26th of September 2022. We only need to keep track of these dates when we are buying shares of a company just to receive dividends. But if we already have the company's shares in our Dmat account, then we don't need to pay attention to all this. We will keep getting the dividends whenever the company declares it. Dividends can also lead to substantial long-term profits. It's possible that a company is making a profit of 100 crore rupees today and giving a dividend of 1 rupee per share. But in 10 years, if the company increases its profit to 1,000 crore rupees, it's possible that the company might also increase its dividend from 1 rupee to 10 rupees per share, resulting in a dividend that's 10 times larger. However, whether to pay dividends or not is a decision left to the company. If the company believes that it needs all the profits it has earned to grow its business, then the company can decide not to give dividends. And in such cases, our profits would primarily depend on the increase in share price. So we have now understood dividends, and we have already understood why a company's share price increases in the long term. But when a company's share price increases, what actually changes in the company? Let's find out the answer in the next lesson. That too by understanding just a simple equation. We have seen that when a company increases its profits significantly over a long period, investors are willing to pay a higher price to buy shares of that company, which causes the company's share price to rise. We can understand this phenomenon with the help of 2 ratios related to the company. First is earnings per share, or EPS, and second is the price-to-earnings ratio, or PE ratio. Earnings per share refers to the amount of net profit a company is generating on its every share in a year. The formula to calculate EPS is earnings per share is equal to net profit divided by the number of shares outstanding. Net profit means the amount of money a company has generated in a fixed period, and the number of shares outstanding means the total number of shares investors own in a company. For example, if a company's net profit is 100 crore rupees and it has 20 crore shares outstanding, the EPS would be calculated as 100 crore rupees divided by 20 crore shares, which equals 5 rupees per share. Whereas the PE ratio of a company shows how much money investors are willing to pay today for every 1 rupee of profit that the company generates. The formula to calculate PE ratio is equal to share price divided by earnings per share. For example, if a company's share price is 75 rupees and its earnings per share is 5 rupees, then its PE ratio would be calculated as 75 rupees divided by 5 rupees, which will be 15. This implies that investors are willing to pay 15 rupees for every 1 rupee of profits made by the company. And when a company's earnings per share increase consistently year after year, investors start buying its shares at higher prices. Due to this, the company's share price rises quickly, leading to an increase in its PE ratio. This is known as PE expansion. After understanding EPS and PE ratio, we can now learn the equation that explains how a company's share price grows in the long term. And that equation is, share price is equal to EPS multiplied by PE ratio. Yes, friends, a company's share price is the product of its EPS and its PE ratio. And as a company's EPS or PE ratio increases, the company's share price also increases in the same way. For example, let's consider that we've invested in a company named AB Limited. The earnings per share of this company is 5 rupees, and the price-to-earnings ratio is 10. This means that the current share price of AB Limited would be share price is equal to 5 rupees into 10, which is 50 rupees. Now, if after 3 years, the earnings per share of AB Limited becomes 10 rupees and the price-to-earnings ratio becomes 12, then the share price of AB Limited will be share price is equal to 10 rupees into 12, which is 120 rupees. If after 5 years, AB Limited's earnings per share becomes 15 rupees and the price-to-earnings ratio becomes 15, then the company's share price will become 225 rupees. After 10 years, if AB Limited's earnings per share become 25 rupees and the PE ratio is 25, then AB Limited's share price would be 625 rupees. And after 15 years, if the EPS of AB Limited becomes 40 rupees and the PE ratio becomes 30, then the share price of AB Limited will be 1,200 rupees. Friends, the share price of a good company increases in this same manner over the long term. The company makes good decisions in its business and increases its net profit, which makes the company's earnings per share go up. Then investors get eager to give more money for such company shares. This increases the company's PE ratio, and both of these factors lead to an increase in the company's share price. Here, the equation we saw reveals how we can create a large profit in a company over a long time. That's why this equation or formula is also called the formula of high returns in the stock market. If we focus on this formula, we can observe that if either the EPS or PE ratio increases, the share price will increase. However, typically a company's EPS and PE ratio both change over time, and that's why both of them affect the share price. We have now understood that by investing in the stock market, we can make money. However, different investors adopt different strategies when investing in the stock market because their investing philosophies vary. Let's explore these investing philosophies and how investors approach them. In order to invest in the stock market, investors use different strategies. But all investing strategies can be categorized into two types of investing philosophies. The first is called passive investing philosophy, and the second is called active investing philosophy. Investors who follow the passive investing philosophy believe that in the long term, we cannot in any way earn returns higher than the average returns of the stock market. This means that if a stock market index has given a 15% yearly return in the long term, then by investing in the companies of that same market for the long term, we can only achieve a maximum return of 15% per year. Therefore, investors who follow the passive investing philosophy consider the effort to find good companies in the stock market as foolish. In the passive investing philosophy, investors believe that no matter how much analysis is done before investing in any company, the returns generated over the long term cannot exceed the returns of the stock market. And that's why instead of investing in individual stocks, they invest directly in the stock market index. In this way, they aim to achieve returns similar to the return generated by the stock market index, which they consider to be the maximum possible return achievable in the stock market. And they mostly make investments in the stock market index through index funds. Friends index funds are a particular type of mutual fund that only invest in companies included in the stock market index. For example, if an index fund is based on the Nifty 50, it will only invest in the 50 companies present in the Nifty index, and that too in the same proportion as these companies are present in the stock market index. Thus, investing in an index fund is similar to investing in a specific stock market index. Actually, passive investing philosophy is based on the efficient market theory, which suggests that all investors in the stock market are always rational. This means they always make their decisions after careful and logical thinking, which makes the stock market an efficient system that accurately reflects the share prices of every company at all times. And in this system, it's never possible that we would get shares at prices lower or higher than their true value. Whereas active investing philosophy is exactly opposite to the passive investing philosophy. Investors who follow the active investing philosophy believe that most investors in the stock market are irrational. This means that they make their decisions not by thinking carefully, but in haste, fear, and greed, which makes the stock market an inefficient system from time to time. And this often leads to companies' share prices being much lower or much higher than their true value. And by taking advantage of this, it's possible to generate much higher returns compared to the long-term performance of the stock market index. Investors who follow the active investing philosophy believe that if we diligently analyze companies in the stock market, we will surely find good companies at prices lower than their true value. And by investing in them, we can earn returns much higher than the stock market's average returns in the long term. All the successful investors whose stories we hear, they all have earned returns much higher than the average return of the stock market index, and that too for many years. Over the past 50 years, the stock market in America has given an average yearly return of 10%. However, the world's greatest investor, Warren Buffett, has achieved a yearly return of 20% during these same 50 years. Similarly, in India, the late investor Rakesh Jhunjhunwala has managed to achieve an average yearly return of around 65% over his 37 years in the stock market. In contrast, during these same 37 years, the Indian stock market index has provided a return of about 14%. Investors who follow the active investing philosophy believe that we should invest in an index fund only when we don't understand the stock market well or when we don't want to put effort into researching stocks ourselves. But if we understand the stock market and can analyze companies for investment, then by investing in individual company stocks, we can achieve returns much higher than the stock market index in the long term. Friends, investors who follow the passive investing philosophy only invest in the stock market index, while those who follow active investing philosophy, they attempt to achieve higher returns than the stock market index through various investing strategies. Which investing strategies are these, and which one of them is the most successful? Let's find out in the next lesson. Friends, active investing strategies are mainly divided into three types of investing strategies: growth investing, dividend investing, and value investing. In a growth investing strategy, investors invest in companies that are rapidly increasing their revenue and profits compared to other companies in their industry. And generally in this strategy, investors are willing to invest in companies at any price. In the growth investing strategy, investors believe that if a company has been increasing its revenue and profits rapidly for several years, there is a high chance that it will continue to increase its revenue and profits at the same pace for some more time. This will cause its share price to rise, resulting in profits for the investors. Whereas in dividend investing, investors put their money into companies that consistently give good dividends, which provides income for investors on their investments. That's why dividend investing is also referred to as income investing. In dividend investing, investors focus on receiving dividends more than the increase in share price, as their main goal is to make a good yearly dividend income on their investment. And in value investing, investors invest in companies whose share price is lower than their true value. This means they are getting these shares at a cheaper price than their actual value. And when the company's share price increases from this lower price to its true value, investors sell the shares they bought at the higher price and make a profit. In value investing, investors believe that each company has a correct share price, which is called its intrinsic value. The intrinsic value of each company depends on the strength of its business and its ability to make profits. Often in the short term, the share prices of companies become lower than their intrinsic value. In such cases, we can buy the company's shares at a discounted price. But in the long term, the share price of every company tends to come close to its intrinsic value, and then we can make a profit by selling the shares that we have bought at a discounted price for a higher price. Now, if we talk about making a profit in the long term using these three strategies, then the most successful strategy has been the value investing strategy. Started in 1934, this strategy has consistently generated the most profit in the long term. If we look at the most successful investors from abroad or India, like Warren Buffett, Charlie Munger, Peter Lynch, Seth Klarman, Howard Marks, Mohnish Pabrai, Prem Vatsa, Ramdev Agrawal, Vijay Kedia, Sanjay Bakshi, or Rakesh Jhunjhunwala, all of them have made significant wealth in the long term through the value investing strategy. One of the most successful investors in the world, Charlie Munger, even says that dividing investing into various strategies is foolish, as all forms of intelligent investing ultimately boil down to value investing. And the biggest return in the long term comes when we follow the value investing strategy to invest in good and growing companies. That is, when we invest in a company that is rapidly increasing its revenue and profits, and its share price is below its intrinsic value. This is when we can achieve the highest returns in the long term. Friends, when the value investing philosophy is so simple and logical that investors can achieve great success by following it, then why don't all investors follow it? And why does value investing always work? To understand the answer, let's learn about the history and philosophy of value investing. The concept of value investing began with the great investor and teacher Benjamin Graham's book, Security Analysis, which was published in 1934. He explained value investing again in a very simple way in his another book, The Intelligent Investor, published in 1949. For a long time, people have always perceived the stock market as a kind of gambling. But after the market crash of 1929 to 30, which resulted in millions of dollars in losses for Benjamin Graham, he conducted extensive studies and developed a theory for investing. He explained in this theory that every company has an intrinsic value, which is different from its share price. And this value, unlike the company's share price, doesn't change every day. This is because intrinsic value depends on how strong the company's business is and its ability to generate profits, which for any company doesn't change in a day, rather it takes time to change. And because of this, a company's intrinsic value also changes gradually over time. Benjamin Graham said that because the share prices of every company change quickly in the short term, it often happens that a company's share price becomes higher or lower than its intrinsic value. And when a company's share price falls below its intrinsic value, he referred to it as an undervalued company, meaning the company is being sold at a discounted price compared to its actual value. And when a company's share price exceeds its intrinsic value, he called it an overvalued company, meaning the company is being sold at an expensive price compared to its actual value. Benjamin Graham explained that if we want to make a profit in the stock market, we need to invest in companies or buy their shares only when they're undervalued, meaning when their share price is lower than their intrinsic value. And we should sell them when they become overvalued, meaning when their share price is higher than their intrinsic value. Benjamin Graham was also Warren Buffett's teacher, and he was the one who taught Warren Buffett the strategy of value investing. And even today, Warren Buffett credits Benjamin Graham for his success. Learning from Benjamin Graham's teachings, Warren Buffett became an even better investor over time. And following in his teacher's footsteps, he also taught people about investing through his writings and interviews, which has helped many investors make a lot of money. Some of India's most successful investors, like Rakesh Jhunjhunwala, Ramdev Agrawal, Sanjay Bakshi, and Vijay Kedia learned investing by reading Warren Buffett's writings and many books on him, and over time they became highly successful investors. In this way, if we look at it, the beginnings of all these were done by the teacher inside Benjamin Graham. He could have kept his developed strategy to himself and made a lot of money in the stock market. But he chose to spread his strategy to as many people as possible through books, courses, and by teaching in colleges. He did this so that more and more people could understand investing and make money from the stock market. Warren Buffett says that some people enjoy the fruits of trees planted by others, while some people prefer to plant trees, knowing that when the tree grows big, they won't be around to enjoy its fruits. And Benjamin Graham was one such person. Warren Buffett often says that if in 1949, when he was 19 years old, he hadn't read Benjamin Graham's book, The Intelligent Investor, and hadn't attended Columbia University to learn from him, he would never have become such a successful investor today. Like his teacher Benjamin Graham, Warren Buffett wants the world to remember him as a teacher rather than just an investor or businessman. That's why he always provides knowledge about investing to people through his writings, interviews, and his company's annual meetings. Friends, Warren Buffett says that the concepts of investing are very simple, and if he were to teach investing, he would only teach two things, which when learned can make anyone a good long-term investor. What these two things are and how we can learn them, let's discover in the next lesson. Warren Buffett says that we only need to learn two things to become a successful investor. First is how to think about stock market, meaning how we should think about the stock market as well as what the stock market is and how it works, understanding it thoroughly and developing the right mindset for investing. And the second is how to value companies, which means estimating the value of companies, that is, determining their intrinsic value, so that we can find out if a company's share price is lower or higher than its intrinsic value, which will help us understand if the company is undervalued or overvalued. Warren Buffett considers investing to be a simple process, but he doesn't believe that applying it correctly is as easy, because if it were that easy, then everyone would become a successful investor. But he does say that if we follow Benjamin Graham's teachings properly, just as he has done, then in the long term we can definitely become a successful investor. In order to develop the right mindset for the stock market, Warren Buffett advises us to understand the cycle of fear and greed in the stock market. He says that when the share prices of companies keep rising and become overvalued, often investors become greedy and are willing to buy shares of these companies at any price. But when the share prices of the same companies crash and we get them at undervalued prices, then due to fear, investors are not ready to buy shares of these companies at any price. But Warren Buffett says that if we want to become successful investors in the stock market, we need to do the opposite. This means we should buy shares when their prices have dropped significantly and are at an undervalued price, and we should sell shares when their prices have greatly increased and are at an overvalued price. To calculate the intrinsic value of a company, we need to understand a lot about the company's business, which is also known as conducting fundamental analysis of the company. In fundamental analysis, there are mainly two types of analysis. One is called qualitative analysis, and the other is called quantitative analysis. In qualitative analysis, we understand things like the company's business strength, the quality of its products and services, the strength of its brand, and the quality of its management. While in quantitative analysis, we analyze the company's financial statements. Financial statements are documents created by the company, in which companies use numbers to show many things related to their business. To understand companies even better, we also conduct ratio analysis of them, where we use different types of financial ratios to analyze the company. Friends, through fundamental analysis, we gain a lot of important information about a company, such as its financial strength, chances of business growth, or chances of profit growth. And then, by using all these factors, we estimate the company's intrinsic value in various ways. Well, understanding the intrinsic value of a company is a somewhat complicated process. But if we grasp the basics of business, investing, stock market, and finance, we can definitely learn it over time through practice. That's why we will learn it in depth in our other courses. Friends, until now, we have learned that by following the strategy of value investing in the stock market, if we invest in good companies for the long term, we can make a good amount of money. But how much money can we really make from the stock market in the long term? 1 crore rupees, 5 crore rupees, 50 crore rupees, or even more than that? Let's find out in the next lesson. To know how much money can be made by investing in the stock market, let's take a look at some examples. Mohammad Anwar Ahmed, a resident of Amalner in Maharashtra, bought 100 shares of Wipro Limited at a price of 100 rupees per share in 1980 by investing his 10,000 rupees. He has never sold a single of these shares till now, and today the value of his 10,000 rupees is more than 1,000 crore rupees. During this period, he also received dividends of around 180 crore rupees, whereas Vijay Kedia, who is considered one of India's most successful investors today, didn't even have 14 rupees at one point to buy powdered milk for his son. But he loved the stock market immensely and kept learning about it day and night for years. And today his net worth is approximately more than 800 crore rupees. Widely known as the Warren Buffett of India, successful investor Rakesh Jhunjhunwala started stock market investing with 5,000 rupees. And by the time of his demise, the value of his investments was more than 10,000 crore rupees. If we talk about companies, Infosys has given a return of nearly 6,000 times since its IPO in 1993 until now. This means if someone had invested 1 lakh rupees in Infosys during its IPO, today its value would have been around 60 crore rupees. If we look at recent times, in 2011 the share price of Bajaj Finance Limited was around 70 rupees. Which is now around 7,000 rupees. This means that in these 12 years, the share price of Bajaj Finance has grown 100 times. In all of these examples, there are two things that are common. First, all of these are very good and financially strong companies. And second, all of them have given the big return in the long term. So it is very clear that in order to make big money in the stock market, what we need to do, and that is to invest in good and financially strong companies for the long term. The reason why so much money is made in the stock market over the long term is because of the working of compound interest, which causes even a small amount to grow significantly over the long term. But what is compound interest, and how does it work in the stock market? Let's learn in the next lesson. During our school days, we had learned that there are two types of interests. One is simple interest, and the other is compound interest. In simple interest, we receive interest only on our invested amount. For example, if we invest 1 lakh rupees at a yearly simple interest of 10% for 3 years, then for the next 3 years, we will receive 10% of our 1 lakh rupees, which is 10,000 rupees each year. And after 3 years, we will get back our initially invested 1 lakh rupees. In this way, over the course of 3 years, we will earn a total of 30,000 rupees in interest on our 1 lakh rupees, meaning our 1 lakh rupees will become 1 lakh 30,000 rupees in these 3 years. But in compound interest, we not only earn interest on our invested amount, but also on the interest that we earn. This happens because in this case, the interest we earn gets added to our invested amount, resulting in the growth of our invested amount. And as a result, the interest we earn also increases. For example, if we invest 1 lakh rupees at a yearly compound interest rate of 10% for 3 years, then after the first year we will earn 10,000 rupees on our 1 lakh rupees according to the 10% rate. But instead of receiving this 10,000 rupees directly, it will be added to our invested amount of 1 lakh rupees, which means our invested amount of 1 lakh rupees will become 1 lakh 10,000 rupees for the second year. And then in the second year, we will get 10% interest on this increased amount. Here, our invested money for the next year will increase from 1 lakh rupees to 1 lakh 10,000 rupees, on which at a rate of 10%, we will receive interest of 11,000 rupees at the end of the second year. But since we have invested for a total of 3 years, this interest will be added again to our new investment amount of 1 lakh 10,000 rupees. And for the third year, our invested amount will increase from 1 lakh 10,000 rupees to 1 lakh 21,000 rupees. And then in the third year, we will receive 10% interest on this increased amount. So for the third year, our invested amount will be 1 lakh 21,000 rupees, on which at a rate of 10%, we will receive interest of 12,100 rupees at the end of the third year. So in this manner here, we will get 10,000 rupees of interest in the first year, 11,000 rupees in the second year, and 12,100 rupees in the third year. This means we will get a total of 33,100 rupees of interest in these 3 years. In this way, in 3 years, our 1 lakh rupees will become 1 lakh 33,100 rupees. But with simple interest, our 1 lakh rupees would have grown to only 1 lakh 30,000 rupees in 3 years. This means that due to compound interest, we received 3,100 rupees extra without doing anything. Here we have taken a 3-year example just to understand compound interest, and it might not seem like a big difference between the 30,000 rupees from simple interest and the 33,100 rupees from compound interest. But if we look at the long term, there will be a significant difference in both amounts, because in simple interest, the amount we invested will remain the same, which is 1 lakh rupees, and every year we will get 10% interest on it, which will be 10,000 rupees. But with compound interest, as the interest keeps getting added to the invested amount, we will earn more interest on that, and our money will grow very quickly. In our example, if instead of 3 years we invest for 20 years, then by investing with simple interest, our 1 lakh rupees will become a total of 3 lakh rupees in 20 years. However, by investing with compound interest, our 1 lakh rupees will grow to a total of 6 lakh 72,750 rupees in 20 years. This means that due to compound interest, we will earn 3 lakh 72,750 rupees more than simple interest over 20 years. In the stock market too, when companies consistently increase their sales and profits, they also grow like compound interest. This leads to a significant increase in their sales and profits in the long term, and subsequently their share price also increases in a similar manner. For instance, if a company's EPS or earnings per share is currently 5 rupees and its PE ratio is 15, then its share price would be share price is equal to EPS into PE ratio, which is 5 rupees into 15, it'll be 75 rupees. But if the company is performing very well in its business and its EPS keeps growing at a rate of 20% for 20 years, then in 20 years its EPS would compound to approximately 192 rupees. And if the PE ratio remains 15 even then, the company's share price would be 192 rupees into 15, that is 2,880 rupees. But often it happens that when a company consistently shows good growth, its PE ratio also increases significantly. So if the company's PE ratio increases from 15 to 25 over 20 years, then the company's share price will become 192 rupees into 25, which is 4,800 rupees, making the share price 64 times higher than the 75 rupees from 20 years ago. And if we had invested 2 lakh rupees in this company at the price of 75 rupees 20 years ago, then in 20 years that investment would have also increased 64 times to become 1 crore 28 lakhs rupees. And it's because of this power of compound interest that substantial wealth is generated in good companies in the long term in the stock market. We have understood how compound interest works. Now let's learn about a highly important concept related to this, known as CAGR. When an amount grows with compound interest, the interest rate associated with it is what we refer to as the CAGR, or compound annual growth rate of that amount. In investing, whenever we talk about the rate of returns or the rate of growth, we are actually talking about the CAGR of returns or growth. As we saw in the example from the previous video, the earnings per share of a company increased from 5 rupees to 192 rupees over 20 years at an annual growth rate of 20%. Since here the rate of 20% is the compound interest rate, we call this rate the CAGR. So here we can say that the company has grown its EPS at a CAGR of 20% over 20 years. Friends, we have said many times that in the stock market, we can earn a yearly return of 14% to 16% in the long term. This means that in the long term, we can earn returns at a CAGR of 14% to 16% in the stock market. If we know the investment amount, the CAGR of returns, and the investment duration, we can calculate the final amount of our investment using this formula. The final amount is equal to initial amount into 1 plus R divided by 100 to the power n. Here, the initial amount refers to the money we initially invested. The term R represents the compound interest rate as a percentage, and N represents the duration of the investment. We need to ensure that both the interest rate and investment duration are in the same time format. For example, if we have taken the interest rate on a yearly basis, then the duration should also be in years. Or if we have taken the interest rate on a monthly basis, then the duration should also be in months. Let's understand this with an example. If we invest 2 lakh rupees at a 15% annual CAGR for 10 years, then after 10 years our final amount will be, the final amount is equal to 2 lakh rupees into 1 plus 15 divided by 100 to the power 10, which will be approximately 8,09,112 rupees. Whereas if we invest the same 2 lakh rupees at a 15% annual CAGR for 20 years, after 20 years, our final amount will be around 32,73,397 rupees. And after 30 years, the same 2 lakh rupees with 15% annual CAGR will become approximately 1 crore 32 lakhs 42,354 rupees. In this way, the longer the period our amount grows through compound interest, the larger our amount becomes. And in the long term, we cannot even estimate how much an amount can grow through compound interest. As in the example, our 2 lakh rupees became 8,09,112 rupees with a 15% annual growth rate in 10 years, 32 lakhs 73,397 rupees in 20 years, and 1 crore 32 lakhs 42,354 rupees in 30 years. But can you guess what will happen to our 2 lakh rupees in 50 years if it grows at a rate of 15% per year? Will it become 3 crore rupees, 5 crore rupees, or 10 crore rupees? So friends, all three answers are wrong because the correct answer is 21 crore 67 lakhs 31,488 rupees. Yes, and this is the power of compounding in the stock market. But to achieve this, we need to have patience, and we need to invest for the long term only in good companies. Friends, here we invested 2 lakh rupees only once, which grew to around 21 crore rupees in 50 years with a 15% CAGR. But if we want to make money in the stock market, we will not invest just once, but repeatedly. And if we invest an additional 1 lakh rupees every year after investing 2 lakh rupees, we can reach the same 21 crore rupees in around 23 years and 1 month instead of 50 years. Yes, friends. After investing 2 lakh rupees, by investing 1 lakh rupees every year, we can reduce the time it takes to reach 21 crore rupees from 50 years to approximately 23 years. And if instead of 1 lakh rupees, we invest 2 lakh rupees every year, it will take us only 18 years and 5 months to make 21 crore rupees with a 15% annual growth rate. If we know the initial amount, final amount, and the investment duration, then we can also calculate its CAGR. We just need to arrange the same formula a bit, which will become The CAGR is equal to the final amount divided by the initial amount to the power 1 by n minus 1 into 100. For example, if we have invested 1 lakh rupees for 10 years, and after these 10 years it grew to 5 lakh rupees, we can calculate the CAGR of the return. The CAGR is equal to the final amount 5 lakhs rupees divided by the initial amount 1 lakh rupees to the power 1 by 10 minus 1 into 100, which will be 17.46%. This means that our investment grew at an average rate of 17.46% per year over the 10-year period, which turned our 1 lakh rupees into 5 lakh in 10 years. Friends, in the stock market, investors often aim to double their money. For this, they need to know with a fixed CAGR return how much time it will take for their investment to double. Or if they want to double their money in a fixed time, they need to find out the CAGR required. And for both these scenarios, there's a simple formula known as the Rule of 72. Let's learn about this in the next lesson. How much time does it take for money to double with a fixed CAGR? Or how much CAGR of returns do we need for money to double in a fixed period of time? To calculate this accurately, complex calculations are required. But with the help of the Rule of 72, we can easily calculate both of these things approximately right in our minds. So if we know the CAGR, we can calculate the time it takes to double using this formula. The time to double is equal to 72 divided by CAGR. For example, if we are getting returns with a CAGR of 15%, then it will take us 72 divided by CAGR 15, that is approximately 4.8 years to double our money. Similarly, if we are getting returns with a CAGR of 24%, then it will take us 72 divided by 24, which is approximately 3 years to double our money. In this way, whatever the CAGR returns we are getting, dividing 72 by it will give us the time it will take to double our money at that rate of CAGR. Similarly, to determine what CAGR return is needed to double our money in a fixed time period, we can also calculate that using the same formula. We just need to rearrange the formula a little, and that would be CAGR is equal to 72 divided by time to double. For instance, if we want to double our money in 4 years, we need to make a return with a CAGR equal to 72 divided by the time to double 4 years, which will be 18%. Similarly, if we want to double our money in 6 years, we need to make a return with a CAGR equal to 72 divided by 6, which will be 12%. In this way, whatever time period we want to double our money in, dividing 72 by it, will give us the required CAGR to double our money in that time. While using the Rule of 72, remember that we need to keep both the CAGR and time in the same format. For example, if we've taken CAGR on a yearly basis, then we'll get time in years as well. And if we've taken time on a yearly basis, then we'll get CAGR in a yearly format too. The Rule of 72 provides us with approximately accurate answers, and that too without any complex calculations. This is why investors are often introduced to it right at the beginning of their investing journey, so that they can use it in their investment decisions. Until now, we've learned about investing in the stock market, but many people prefer trading in the stock market instead of investing, where profit also comes from buying and selling shares. So, what is the difference between investing and trading after all? Let's understand this in the next lesson. In stock market investing, we make profits when the company we have invested in performs well over the long term. Due to this, its share price increases in the long term, resulting in a profit for us. In other words, in investing, our profit comes from the growth of the company's business. But we have also learned that the share prices of companies can fluctuate rapidly in the short term due to various reasons. And in such cases, if someone buys shares at a low price and sells them at a higher price, they can make a profit too. And this is called trading. And those who engage in trading are called stock traders or simply traders. Trading means that we want to make profits only from the movement of share prices. We don't care at all whether the company is good or bad, financially strong or weak. Because in this, we only focus on the movement of share prices. And if we believe that a company's share price can increase, we buy its shares. And if its price indeed rises, we sell it at a higher price to make a profit. The basic philosophy of trading is that every company's share price follows a pattern that allows us to predict its movement. And based on this prediction, we can buy and sell shares to make a profit. To understand the pattern of share prices, traders often analyze the chart of share prices and the volume of shares traded. The volume of a company's shares indicates how many shares were bought and sold in a day. Friends, we saw that in investing, when we study a company's business in detail, it's called fundamental analysis. Whereas in trading, when traders analyze a company's share price patterns and volume to anticipate its share price movement, it's called technical analysis. So in investing, investors use fundamental analysis, and in trading, traders use technical analysis. Investors aim to make a profit by capitalizing on a company's business growth. Traders, on the other hand, try to make a profit solely from changes in a company's share price. Trading mainly falls into three categories: intraday, swing, and scalping. In intraday trading, traders buy and sell shares within the same day, which leads to their profit or loss occurring on the same day. In swing trading, traders buy and sell shares over a period of at least one day to several weeks. And in scalping trading, traders quickly buy and sell shares within just a few minutes or seconds to complete their trade. While doing trading, our attention is solely on the movement of share prices. If the price movement aligns with our expectations, we make a profit. However, if the share price moves contrary to our expectations, we could also incur losses. That's why trading involves a significant amount of risk. And all successful investors advise newcomers to avoid trading altogether. Trading is usually done in stocks, derivatives, and commodities. Stocks involve shares of companies. Derivatives are a type of contracts based on company shares or stock market indices. It mainly includes futures and options. In commodities, there are things like crude oil, gold, and silver. It is worth noting that trading occurs in the short term, and the biggest risk in this is that the stock prices of companies can go up or down anywhere, making trading highly risky. And we can incur a very large loss very quickly. Most successful investors have made their money not through trading, but rather through long-term investing. And that's why accomplished investors like Warren Buffett, Charlie Munger, Howard Marks, Ramdev Agrawal, Vijay Kedia all advise us to not do trading and recommend learning long-term investing right from the beginning. Friends, we've seen that fundamental analysis is used for investing, and technical analysis is used for trading. However, there are some people in the stock market who don't engage in either of these approaches, and they often end up with long-term losses. In the next lesson, we'll explore who these individuals are, why they follow this path, and how they differ from other investors. Friends, in the stock market, there are many people who neither do fundamental analysis for long-term investing, nor do technical analysis for trading. Instead, these people, upon hearing anyone's words, without thinking, understanding, and analyzing, buy any stock with the hope that they might be very lucky, and the share price of the company they bought might increase 2 or 5 times. Such people think of the stock market as gambling and a game of luck, and that's why they perceive buying shares as an attempt to test their luck. In doing so, they often incur losses on their investments, and then they proceed to tell others that the stock market is a game of gambling and luck. One of India's most successful investors, Vijay Kedia, says that when it comes to becoming an engineer, doctor, or IAS officer, one needs to put in a significant amount of study and effort. Even obtaining a job with a salary of 30,000 rupees demands a lot of hard work. But when it comes to the stock market, people think it's easy. And due to this misconception, people buy shares of any company without doing any research. Over 90% of people in the stock market incur losses, primarily because they start investing without proper preparation. Friends, we should consider investing as a serious business because here we invest our hard-earned money, and investing without proper knowledge will only lead to losses. We should only invest in a company after conducting thorough research and analysis, and it's always wise to invest in good and strong companies which have very high chances of business growth in the future. America's most successful mutual fund manager, Peter Lynch, believes that the public becomes aware of good companies long before investors do. This is because the public has been using the products and services of these companies for years. And if we pay attention to the things we use in our daily lives, we might discover several good companies. People often make the mistake of starting to search for good companies only when they have funds to invest, which is a wrong strategy. Instead, we should always keep looking for good companies so that we have a ready list of good companies beforehand. And when the market crashes or when we have funds, we can invest in those companies from our list which are available at a lower price. Many successful investors make a list of good companies for themselves so that when the right opportunity arises, they don't waste time looking for companies and can make quick decisions to take advantage of the opportunity. Friends, in the first chapter, we saw that the best way to build financial wealth is by doing business. However, many investors consider investing to be a superior option to running a business. Why do investors think this way? Let's know in the next lesson. Friends, if we want to make money without stress, then investing in the stock market is much better than doing our own business. Let's understand its many reasons. First, starting a business is much more difficult compared to starting to invest. We can start investing whenever we want, that too with 500 or 1,000 rupees. Whereas to start a good business, we might need investments of lakhs of rupees. Often what happens is that we really like a business idea, but after some time we start liking another idea. In such a situation, if we had already invested money in our first business idea and started the business, then changing it to the next idea would be very difficult. This means that while doing business, we can't easily change our business. But in investing, it's not like that at all. If we like a company today, we can invest in it. But after some time, if we start liking another company more, we can invest in it too. In this way, through investing, we can become a part of various businesses by investing in the companies we find good. But this is not possible while running our own business. Besides these two things, there are two more factors that make investing the best, which are having an asymmetrical risk-return ratio and room for mistakes. An asymmetrical risk-return ratio means that, in investing, we can lose only the money we have invested in it, but the profit we can make from it could be 5 times, 10 times, or even 100 times of our invested money. For example, if we have invested 1 lakh rupees in a company and bought its shares, the worst thing that can happen is that the company's share price goes to zero, and we lose our entire 1 lakh rupees. But it's also possible that the company's share price increases by 5 times, 10 times, or 100 times, and our 1 lakh rupees turn into several crores. On the other hand, having room for mistakes means that even if we make several mistakes in investing, we can still make a lot of money in the long term. Well-known Indian value investor Ramdev Agrawal says that even most successful investors are right only about 6 out of 10 times, and if we manage to be right about selecting companies 4 or 5 times out of 10, we can make very good money in the long term. This happens because the profit generated in the long term from a single good company far outweighs the total losses incurred by many other companies, which results in lower losses and higher profits for us in the long run. And that's why even after facing losses in many companies, we still make profits. For example, let's say we invested 1 lakh rupees in each of 10 companies, meaning we invested a total of 10 lakh rupees. Now, after 5 years, it's possible that out of these 10, we might experience a 50% loss in 6 companies. This means that the money we invested in each of them, which is 1 lakh rupees, would be reduced to 50,000 rupees. In 2 companies, there might be no loss or profit, so our investment of 1 lakh rupee remains the same in these 2. But in the remaining 2 companies, we might make a profit that is 10 times, meaning that our invested 1 lakh rupee in each of these 2 companies becomes 10 lakh rupees. So in 6 companies with a 50% loss in each, the 6 lakh rupees we invested has become 3 lakh rupees. In 2 companies with neither profit nor loss, the 2 lakhs rupees we invested remain the same, and in 2 companies, due to 10 times profit in each, our invested 2 lakh rupees has become 20 lakh rupees. In this way, the total value of our invested 10 lakh rupees will become 3 lakh plus 2 lakh plus 20 lakh, which is 25 lakh rupees. Here, even though we faced a 50% loss in 6 out of 10 companies, our initial 10 lakh rupees have grown to 25 lakh rupees. This is because the profit from 2 companies was much higher than the losses from the 6 companies. And this is exactly what happens in stock market investing. Every time, we just need to try our best to invest in good companies so that we can reduce the chances of loss. But even then, it's inevitable that we'll face losses on some of our investments. There's no need to worry about it, because even the best investors in the world don't always make profits in all their investments. Considering these factors, we can say that through long-term investing, we can surely create financial wealth for ourselves, and for many reasons, this is even better than doing business. Let's now learn how we should start investing. To start investing, the most important thing is to have money to invest. And in the stock market, we should invest only that money which we won't need for a few years. Because it's possible that in the short term, the value of our investment may decrease. And if we have to withdraw that money in such a situation, we will incur a loss. All successful investors say that the best way to accumulate money for investing is to save from our income. And if we don't have an income source, we should create one first. And if possible, we should establish not just one, but multiple income sources, so that we can save as much money as possible from them and invest it in the stock market. To invest in the stock market, the first thing we need to do is open a Dmat and trading account with a stockbroker, for which we must have our PAN card, Aadhaar card, and bank account. And whichever bank account we provide at the time of opening the Dmat and trading accounts, we have to do all transactions through that account with the broker, and we also receive dividends directly into that bank account. Friends, if you want to open your Dmat account, we have provided the link for it in the description box. You can easily open your Dmat account through that link. After opening a Dmat and trading account, we can start investing. But that doesn't mean we should immediately buy shares of companies. We should start our investing with mutual funds first, because there is lower risk in mutual funds, and we can easily see in which companies mutual funds have invested, which should help us understand why mutual funds chose to invest in those companies. And mutual funds often inform their investors about this. Additionally, we should read books related to investing and study successful investors. And we should also learn to analyze the financial statements of companies and their valuation. And when we begin to understand companies and their businesses, then we should start buying shares directly with small amounts. And we should make an effort to learn more about the companies we have invested in. The share price of the companies we have invested in will either increase or decrease after some time, and we should try to understand the reasons for both cases. We should thoroughly analyze the company's annual and quarterly reports, and especially pay attention to the statements made by the management, so that we can better understand the company's future. When we start to see profits on our small investments, only then we should increase our investment amount. Every time we invest in a company, we will either do well or make mistakes. We should try to learn from both, so that we can repeat the good decisions and avoid making the same mistakes again. In this way, the journey to becoming a successful investor in the stock market is divided into two phases. The first one is called the learning phase, and the second one is called the earning phase. In the learning phase, our entire focus is on learning by investing small amounts. In this process, we might sometimes make a profit, and sometimes face a loss in our investments. But we should aim to learn as much as possible about investing, the stock market, companies, and business. And then, as we continue to learn, it happens that we start experiencing less loss and more profit in our investments, which means that we have now moved from the learning phase to the earning phase. Many people often make the mistake that while learning, they start feeling that they have learned enough and now it's time to make a big investment. But doing this is a big mistake. The journey from the learning phase to the earning phase happens gradually on its own. When we start to see more profits than losses in our investments, our investment amount starts to increase on its own, and we enter the earning phase. Successful investors believe that even if we have moved from the learning phase to the earning phase and are making significant profits by investing large amounts in the long term, we should always keep our mindset like the learning phase and continue to learn from our right and wrong decisions, so that over time we can minimize our mistakes. Friends, now we have understood the step-by-step process of investing. Let's now understand the fees and taxes associated with investing. While investing in the stock market, we have to pay various types of fees and charges. First of all, we have to pay fees for opening a Dmat and trading account, which can range from 100 to 500 rupees, because different brokers charge different fees for this. And there are some brokers who do not charge Dmat account opening fees, and they open our Dmat and trading account for free. So these fees depend on the broker we choose. The second charge that we have to pay is called AMC, or Annual Maintenance Charge. We have to pay this to our broker every year, and this can be between 300 to 900 rupees. But there are many brokers who do not charge AMC, so this charge will also depend on our broker. After this, whenever we buy and sell shares, we have to pay taxes and brokerage charges on them. It's important to note that we have to pay charges and taxes on both buying and selling shares. These charges depend on how much amount of shares we are buying and selling. The larger the amount of buying and selling, the higher our charges will be. After this, whenever we sell the shares stored in our Dmat account, we have to pay DP charges. Different brokers charge different amounts for this, but usually it's only between 10 to 20 rupees. DP charge is applied only on the day when we sell shares of a particular company. In one day, no matter how many shares of a single company we sell, we only need to pay DP charge once. But if we sell shares of two different companies on the same day, we have to pay DP charges twice for both the companies. Also, if we sell shares of a single company on 2 different days, we also have to pay DP charges twice. After this, we need to pay tax on our profit, which is called capital gains tax. And there are 2 types of it: short-term capital gains tax and long-term capital gains tax. Short-term capital gains tax is applicable to profits made by holding shares for less than 1 year, while long-term capital gains tax applies to profits made by holding shares for more than 1 year. In short-term capital gains tax, we have to pay a 15% tax directly on our profits, while in long-term capital gains tax, we have to pay a 10% tax. However, on long-term profits of up to 1 lakh rupees, no tax is levied. But on profits exceeding 1 lakh rupees, a 10% tax is applicable. For example, suppose that today we invested 1 lakh rupees each in 2 companies, AB Limited and DC Limited. We sold the shares of AB Limited after holding them for 10 months, making a profit of 1 lakh rupees, whereas we sold the shares of DC Limited after holding them for 1 year and 10 months, earning a profit of 1,80,000 rupees. Friends, here we held AB Limited's shares for only 10 months, which is less than a year. So we'll have to pay a 15% short-term capital gains tax on the profits we have made. This means we'll be charged 15% tax on 1 lakh rupees, which is 15,000 rupees. On the other hand, we held the shares of DC Limited for 1 year and 10 months, which is more than a year, and that's why we will have to pay long-term capital gains tax on it. Here we have made a total profit of 1,80,000 rupees. However, since we don't have to pay any tax on long-term profits up to 1 lakh rupees, we will only have to pay long-term capital gains tax on the remaining 80,000 rupees at a rate of 10%, which will be 8,000 rupees. Friends, to understand the tax on profits in the stock market in complete detail, it's advisable to seek the help of a chartered accountant so that we do everything correctly and manage our taxes effectively. Friends, Warren Buffett says that to be successful in investing, it is very important to always keep learning. And for this, besides investing, stock markets, and business, we should also study human behavior and human psychology. Let's explore some learning resources that will greatly assist you on your journey to becoming a successful investor. To learn about investing, all investors suggest reading a lot. And for this, along with reading books, we should also read blogs and letters from successful investors. Talking about books on investing, first of all, we should read Robert Kiyosaki's Rich Dad, Poor Dad and George Clayson's The Richest Man in Babylon. After this, we should read the books written by one of America's most successful fund managers, Peter Lynch. His books are very good for investing in India at this time. His books include One Up on Wall Street, Beating the Street, and Learn to Earn. Next, we should read the books of late investor Parag Parekh, who is considered India's best value investor. He has 2 books titled Stocks to Riches and Value Investing and Behavioral Finance. In addition to this, there are many videos and lectures by him on YouTube. We should watch them as well. After this, we should read the book written by Benjamin Graham, The Intelligent Investor. This book is also called The Bible of Investing. Warren Buffett considers this book to have a very significant role in his success. Besides this, there is another book that Warren Buffett attributes his success to, which is Philip Fisher's Common Stocks and Uncommon Profits. We should also read this. After this, we should read the book The Dundo Investor, written by Indian-American investor Monish Babrai. In this book, he has explained the logic of value investing very well, with many examples. Next, we should read Warren Buffett's biography, The Snowball. And then we should read one of today's best value investors, Howard Marks' book, The Most Important Thing. Friends, in the stock market, along with investing, we also need to learn about human psychology and human behavior. And for that, we should read books like Daniel Kahneman's Thinking Fast and Slow, Robert Cialdini's Influence, Peter Bevelin's Seeking Wisdom from Darwin to Munger, and Charlie Munger's Poor Charlie's Almanac. Charlie Munger has also given a very good speech on human behavior, titled The Psychology of Human Misjudgment, and this speech is freely available in PDF format on the internet. You should definitely read it. Well, there are many more books to learn about investing and human behavior. We have mentioned some of the best books here to start your investing journey. But when you read all these books, you will encounter many more books as well, from which you should read as many books as possible. Friends, along with books, we should also read the letters of successful investors, because in these letters, investors explain their investing methods in great detail. The best among investor letters are Warren Buffett's shareholder letters. He has been writing these letters every year since 1965. You can download these letters for free from the internet under the name Berkshire Hathaway Shareholders Letters. Warren Buffett used to run a private investment partnership firm in the 1950s and 60s, for which he also wrote partnership letters from 1957 to 1970. You can download these letters for free from the internet by the name Buffett Partnership Letters. After this, we should read the letters in the form of memos from Oaktree Capital's value investor, Howard Marks, who has been consistently writing them since 1990. All these memos are freely available on his company's website, oaktreecapital.com. We should also read Amazon's founder Jeff Bezos' shareholder letters, which he has been writing since 1997. In these letters, Jeff Bezos has explained long-term thinking and the mindset to build a successful business very well. Along with books and investor letters, there are also many blogs available today, which can teach us a lot about investing. India's two best investing blogs, which you should definitely read, are Vishal Fundelwal's blog at cephalniveshik.com and Sanjay Bakshi's blog at funduprofessor.wordpress.com. In addition to this, there are many blogs where we can learn about investing and human behavior, as well as important decision-making for investing. Some blogs that you should definitely read are GrahamandDoddsville.net, ContrarianEdge.com, CSInvesting.org, MoiGlobal.com/MOI, CollabFund.com/blog, FSblog, and AcreCapital.com/OurThinking. While reading these blogs, you will also encounter many other good blogs and books that will assist you in your journey of learning about investing. Dear friends, with this, our course comes to an end. And if you have watched this course attentively till the end, we salute you. We are sure that through this course, you will be able to start your journey to becoming a successful investor in the right way. We request you not to stop your journey of learning with this course, but consider this course as a foundation and start progressing ahead and read and learn about more investors and value investing. We want to remind you again that this video course is a complete course in itself, but if you want to perfect your knowledge by solving questions based on the concepts covered in this course, then you should definitely take the test we have created for this video course. This test includes 14 quizzes, one final exam, and over 200 multiple-choice questions. Friends, in scientific research, it has been found that if we repeat a learning 30 times, we remember it forever. Keeping this in mind, we have created concise text notes for this course. These notes will help you easily review the important lessons of this video course. You can access these things on our mobile app, True Investing Academy, or on our website at academy.trueinvesting.in at a very affordable price. We have provided links to these in the description and comment box. Friends, we want to let you know that a few years ago, we also knew nothing about investing. But during this time, we have read over 400 books on investing and finance, watched hundreds of interviews of successful investors, read thousands of blog articles on finance and investing, and gradually learned everything that we have shared in this course. And we are totally confident that you can also learn investing with just a few years of hard work. You just need to keep learning consistently and patiently. And for any doubts, you can always contact us. We are with you throughout your journey of learning to invest. On behalf of the True Investing team, we wish you all the very best for your success in the stock market. Congratulations! Along with completing this chapter of stock market investing, you have also completed this entire course. Let's now carefully review the important learnings from this chapter. We first learned that in the stock market, we can either invest directly by buying shares, or we can invest indirectly through mutual funds, ETFs, or PMS. Then we learned that the share price of companies increases due to their ability to make profits. This is because investors are willing to pay more for the shares of companies that make higher profits. And in the long term, a company's share price depends on its earnings per share, that is EPS and price to earnings or PE ratio. And when a company's EPS increases, its PE ratio also increases, which can lead to the share price increasing by 10, 20, or even 100 times. After that, we explored the concepts of active and passive investing philosophies. In the passive investing philosophy, investors believe that in the long term it is not possible to make higher returns than the stock market index. Therefore, they invest in the stock market index itself. While in the active investing philosophy, investors believe that it's possible to achieve higher returns than the stock market index in the long term, and they use various strategies to try to outperform the stock market index. Then we learned about 3 strategies within the active investing philosophy: growth investing, dividend investing, and value investing. In growth investing, investments are made in companies at any price that have the potential to rapidly increase their revenue and profits. In dividend investing, investments are made in such companies that give higher dividends. And in value investing, investments are made in companies that are undervalued. Then we saw that in the long run, the power of compounding works in the stock market, which enables even a small amount to grow significantly over time. Next, we learned about trading, where traders try to make profits only from the movement of a company's share price. Then we also learned about people who consider the stock market as gambling, and they invest in any company without thinking, understanding, or researching. And in the long term, they make only losses. Then we learned how investing is even better than starting our own business for several reasons. Like in investing, we can easily invest in any industry, while doing the same in our business is not possible. Also, investing requires much less money to start than starting a business. Additionally, we learned that in investing, we can lose only as much money as we invest, but the profit can be hundreds of times. And in investing, despite making mistakes, one can still make a lot of money in the long term. We then learned that we should first start investing with mutual funds and gradually progress by learning about the stock market, business, and companies. After that, we should start investing in company shares with small amounts. And with learning, we can become successful and knowledgeable investors over time. And lastly, we explored various learning resources such as books, investor letters, and blogs, which can help you learn a lot about the stock market, investing, and human psychology, and greatly help you in your journey to becoming a successful investor. Before you go, we again would like to remind you that you have the opportunity to access concise text notes and a quiz featuring over 200 questions summarizing the core concepts from this course. It's all available on our mobile app, True Investing Academy, and our website at academy.trueinvesting.in. We encourage you to explore these valuable resources. You'll find the relevant links conveniently placed in the comments and description box. We once again congratulate you on completing this course on the basics of stock market and investing. If you enjoyed this course, please share it with as many people as possible and become a part of the mission to make India a country of financially smart people. Thank you so much and all the best.